And let me say that I'm very happy to have Rainer Mazera as presenter of the new economic policy for Europe. New economic policy means new economic, monetary, and fiscal policy. And it's very important, the contribution of Rainer Mazera. Rainer Mazera is a professor of economic policy and dean of the University Guglielmo Marconi, Rome. Is member of a high-level group in Europe, author of books and papers on global finance and regulation and on European supervision. Last but not least, was a minister of finance, in the Dini cabinet, it seems to me. I'm sure that his presentation will be very helpful to introduce the topic that we are to discuss in the afternoon. As everybody knows, because I explained this several times before now, the idea is to present the Villa Mondragone conference as a program in which are several contributions, many contributions, but all linked by a general idea, the idea that is expressed by the different areas that considered and presented by the colleagues that accepted to make the presentation, as Rainer Mazera accepted to be with us. The topics that Rainer Mazera will present is a new economic, macroeconomic, and fiscal policy in Europe. Thanks to Rainer. Rainer, the floor is to you.
Thank you very much for the introduction, dear Luigi. It is a pleasure and an honor to be here at this splendid conference. We heard in the initial day the presentations by many top world economists, and I fully concur with their views, and notably on the point that Luigi was and is the mastermind behind this beautiful exercise. Having said that, I will go without ado into my presentation. I was duly impressed by the number of very important speakers who will follow up my brief introduction. And I noted that they were mostly from central banks. And therefore, the title of my brief introduction is The Case for a Different Stability and Growth Pact. That is to say, I will concentrate myself on a few ideas which I have been working for many years on the fiscal approach to European integration. The suspension of the fiscal rules in Europe and the enactment of NGEU provide an opportunity to rethink the inherited budget orthodoxy. The issue at stake, and here I begin my small provocations, is not so much of political economy and institutional changes in the EU, which are necessary, but it is primarily of economic analysis and theory. It is in the realm of these discussions that we should see whether a new consensus or a new approach can be developed. The coronavirus crisis, the pandemic, represented a very serious risk for Europe, but can become an opportunity to face unresolved issues in a different and more satisfactory way. A critical role in this respect is posed by the analysis and the problems of public debt, spending, and fiscal space. We have the stock flow problems of budgetary constraints and possibilities. The traditional approach to government budget restraints and public debt sustainability is based on the assumption that economic agents' deficits and surpluses balance in equilibrium under the constraint, the alleged constraint of intertemporal efficiency. A central, not mainstream tenet of the considerations I bring forward to your attention is that theories arise from experience and should arise from experience. There are not, therefore, general economic theories holding at all times and in all circumstances. Theories are simplifications based on stylized effects. Simplifications which are appropriate at one time may become inappropriate at another. This does not imply the acceptance of global relativism, which is open to the charge of inconsistency and self-refutation. It is the acknowledgement that, notably in times of global uncertainties and of rapid, profound economic and social changes, the evolving threads in economic analysis must be adapted to the underlying processes under review, to events which have come about. Pandemia is an obvious example of what I am suggesting, but it is by no means the example I have in mind. The considerations I am trying to offer to you are more general in nature. From this perspective, I draw one general conclusion. That part of economic orthodoxy, which is in constant search of one timeless general theory of economic equilibrium with self-correcting markets, may turn out to be misleading. Economics, in my view, is not an exact science. Manifold theories, models, and policy prescriptions can be found, notably in terms of public finance. There is no universal truth. This makes it more difficult to select the appropriate theory and model in order to offer a satisfactory explanation to current and prospective trends and developments. At the cost of perhaps excessive simplification, some debated issues on public debt are summarized as follows. And I go back to the classical theory. According to analytical schemes which have roots in the, say, Ricardo Smith writings, the supply of goods and services always creates a corresponding demand. Supply constitutes demand. The principle of effective demand was not accepted by the mainstream classical school, although it had been analyzed in a very clever way by Malthus. But in a catchword, every frugal man is a public benefactor. This is Adam Smith. The problem of effective demand and structural unemployment do not therefore present, by definition, themselves. The economic system and market forces lead automatically to equilibrium and full employment. According to these schemes, public debt can be justified to finance wars and/or the consequences of exceptional events, such as the one we are witnessing now. It must, in any event, be reimbursed with taxes, among which the inflation tax, which is undesirable on many accounts. It is therefore possible to temporarily finance public expenditure by borrowing, but later taxes will have to be increased to repay the debt. For citizens who see beyond the veil of fiscal illusion, debt cannot represent net wealth, but only deferred taxation. The equilibrium standard is therefore balanced budgets. This model, which goes back to the origins of the economic science, was put in a way as a pillar stone of the EU and Economic and Monetary Union. The treaties and the pacts that all contracting countries shared and subscribed hinge on these principles. The EU itself corresponds to these propositions, which accepts the Ricardo's equivalence theorem, which fundamentally states that any increase in public debt implies an equivalent amount of future tax liabilities. So you have an expansionary fiscal impulse, but a countervailing Ricardo effect. I have written a few notes, and I would be very glad to have your comments, and I will make them available to you. The principle which I would like to underline, because it is of fundamental importance, is that the issue of effective demand is discarded, while the neutrality of money and the classical dichotomy are affirmed. This approach is clearly at odds with the paradox of thrift, which Keynes so clearly and aptly indicated. Excess savings can take place, and in this condition, the chain of causation is reversed. It is investment leading to saving, and there must be investment in order to have equilibrium, saving, and income. A decreased propensity to consume can diminish employment and lead to excess savings. All this may seem looking too much backwards, but my point is that this is not the case, and many mistakes in economic analysis are fundamentally related to the fact that we have continued to inherit these views without any critical assessment. And it is in this line that we held until last year or a couple of years ago, the view that public debt inevitably gave rise to a burden on future generations. The argument was propounded by the EU and by many IMF policymakers in the past few decades, and was technically again explained in terms of this intertemporal dynamic efficiency. The idea is that public debt at time t must be covered by the net present value of all future primary balances, as we well know. This would ensure that Ponzi games would not be sustained and budget constraints would be well defined. These points were made recently by De Bruyn et al. And others in 2018 by the IMF, a very long series of papers stating these points and making the point that the assumption had to be in this kind of world that the real rate of interest on government debt would have to be higher than the growth rate of real output, because otherwise the internal consistency of the model would not be satisfied. But this was putting ahead the theory ahead of adherence to facts. In this approach, let me start by indicating to you one clear point, which in my view made this analysis very insufficient. There is no distinction between current and capital nature of public expenditure and to the net yield generated by government capital infrastructure expenditures. We are now coming to these points, and they are becoming the new inherited wisdom. But until a few years ago, this was strongly denied. Not only that, but the relationships between real interest rates, productivity, and growth, which are now again addressed in satisfactory ways, were not addressed. The intertemporal efficiency model was also accompanied by a model of self-sustaining general equilibrium along DSGE lines. These required econometric verification on the basis of measurable probabilities and on the assumption of the stationarity and ergodicity of the relevant time series, which is, however, constantly contradicted by a number of economists, statisticians, and Nobel Prizes. I draw attention to a recent book by Kay and King, which underlines these points, which I repeat were well known. I studied with John Hicks, and he made these points in 1980, but to little avail. The conventional wisdom of that dynamics was therefore based, and I can mention two papers again coming from the IMF and in the line of the so-called Washington Consensus, Escolano and others, Lebrun and others. It was assumed that in equilibrium, the real rate of interest would necessarily exceed the real rate of growth. And it was assumed also that this modified golden rule would have both a theoretical and an empirical basis. On the theoretical part, I do not want to to discuss it here. Certainly what is highly relevant is that there is no evidence of this condition to hold. The available evidence for the last century and of course for the current 2 decades is instead more consistent with the opposite proposition. That is to say, there is no evidence that the interest rate growth differential is strictly positive. It was recognized that this could not be satisfied at times in practice, but this, and I can offer you the relevant references, this was a theoretical curiosum. A primary fiscal surplus would represent a necessary condition to stabilize the debt-income ratio. I would like to spend more time here, but I do not have it. What I indicate is that the neglect of these economists is also neglect of the intertwining between real interest rates and growth rates, and therefore of total factor productivity growth. This could be immediately derived, can be immediately derived from the seminal works of Solow and others, but this is perfectly consistent with later works, notably by Ned Phelps. The model can be further enriched to allow for the saving and investment schedules to be determined in an open economy framework, which paves the way to the analysis of the saving glut proposition. The conversion along the road to Damascus of Blanchard is evidence of what I am pointing out here. And the application of these concepts in the EU was based on an inappropriate utilization of the Domer approach. And Domer wrote a very interesting paper in 1993, which indicated how wrong it was to apply his mathematical analysis to indicate that this was a necessary condition in order to achieve equilibrium. I skip many parts, but I want to indicate to you that the whole idea of the complexity coming from the savings glut hypothesis is an indication of the relevance, not only in simplistic Keynesian models, but in reality of the points I'm making here. But I jump perhaps to some more recent work. I would recommend the work, for instance, of Rice. He indicated in a very clear way that the relationship between R and G and the marginal productivity of capital and the marginal productivity of public infrastructure is a complex story which cannot be subsided by a simple-minded reference to so-called intertemporal efficiency. But in a number of instances, when I tried to develop these points also from an analytical point of view, it was I was told that I did not fully understand the full implication of intertemporal efficiency. I don't know who understood or not understood these problems. Notably, these problems, by the way, have been clearly evidenced in the literature by a number of Nobel Prizes, and I drew specific attention to the work of Arrow and Kurtz in the 1970s. I jump to my current work is on a proposal for a real European public debt, which would be a way to consolidate the NGEU approach, and which starts on the premise that next generation EU was a major advance in policy and in theory, but this must allow for the fact that reproductive debt, good public infrastructure, and good, which leads to crowding in of private investments, is not a poison for future generations. On the contrary, it can be the most important heritage that the current generation bequests to the following. All this is now being accepted, and the idea of a real European public debt can be viewed as the hypothesis of institutional development aimed at the consolidation of sustainable and cohesive growth, and the reformulation of the fiscal pact. I would not like anybody to suggest that what I am indicating here is that the budget constraints can be avoided, that the issue of fiscal space for, notably for high debt countries, can be avoided forever, but this will partly depend on what the ECB will do. My contention is that these problems will arise again, and therefore in my simple model which I produced, the idea is that current expenditures should be always covered by current revenues. So you can, under certain circumstances, and if the rate of return is higher than the rate of growth, continue to impinge upon real investments undertaken by the government sector, provided, of course, it does fulfill the requirements of real growth and real returns. So my model is PMK, that is to say, the productivity, marginal productivity of capital can be higher than G and can be higher than R. For how long, I don't know, but certainly for the foreseeable future, this condition can be met, and it is fundamental to fully exploit this potential for growth in a meaningful way and in such a way as to avoid falling back into the mistakes, policy mistakes and analytical mistakes, which led to the anemic Europe, which was so well indicated in a number of papers by Professor Paganetto. I stop here because my time is over. I repeat, the ideas I have put forward to you can be found in a technical paper, which I will be able to send to those who might be interested, and I would certainly be very interested in receiving back comments and indications. Thank you very much.
This is a very interesting presentation that seems to be a lecture in some extent, because used some theoretical arguments, very important argument, to discuss the problem that the today problem of Europe and investment and relation between real interest rate and productivity. It is a quite important argument because no doubt that looking to this side of the problem, we have the idea of what is the opportunity offered to Europe in this moment, if Europe will be able, and the country that are part member of the Europe will be able to make investment in which the rate return of public investment in infrastructure investment will realize a higher rate of return with respect to real interest rate. This is a point that is absolutely important in my personal view, and I share your position. And it seems to me that this way of looking to the problem of the policy or the economic policy of Europe will be useful for our session, also from the point of view to make a connection between monetary policy and fiscal policy. That's quite an important argument, and let me make a special thanks to you. And my idea that is important to put ahead this point of view in the next future. Thanks. Thank Rainer. And now we have the two different session panel. The first one chaired by Francesco Mongelli. Francesco Mongelli is working at the European Central Bank, is senior advisor of Director General, and Francesco Mongelli produced a lot.
Would you like to put the coronavirus, COVID-19 pandemic, we have 3 excellent papers that will be presented by 3 teams, an IMF team, a Banca d'Italia team, and an ECB team. The first presentation is by Nina Todorova-Budina and Chiara Fratto. Nina is a graduate from the University of Amsterdam. She's working now in the strategy, policy and review department of the IMF, and she co-leads a team investigating distributional effects of monetary policy, a very important topic these days. Chiara is an economist in the Western Hemisphere department. She's a graduate from the University of Chicago, and her interests include applied macroeconomic, urban economics, and monetary policy. So there is awareness that monetary policy easing impacts income and wealth distribution. And today, the MF team will present some empirical evidence on the various channels through which this takes place. The second paper will be presented by Marco Bernardini, who works in the Economic Statistics and Research Department of the Banca d'Italia. He's a graduate from the University of Ghent. The study looks at high-frequency data, confidential data, showing that the impact of APP purchases goes well beyond the announcement effects that usually are attributed to this type of policies. The third paper will be presented by Francesca Barbiero, who is a colleague of mine. She works in the monetary policy department on the bank lending issues, and she's a graduate from the Bocconi University. We have very little time. Presenters have 20 minutes each, so I would not like to delay any further the first presentation. Chiara and Nina, you can proceed. Thank you very much. Question will be welcome at the end of the 3 presentations. Thanks.
Thank you very much, Francesco. Do you see my presentations right now? Do you see the slides? Just confirming.
Yes.
Okay. Thank you very much. Good morning and good afternoon to all the colleagues in Italy. Distributional effects of monetary policies have attracted considerable interest, especially in the context of extensive monetary easing to limit the fallout of the pandemic and previously in response to the global financial crisis. Our presentation focuses on the extent to which developments in within-country income and wealth distribution appear linked to monetary policy, especially monetary policy easing cycles. We will cover the conceptual framework about how to think of channels of distributional effect, highlight our main findings, and summarize the policy implication. Let us first start with the main mechanisms through which monetary policy can have distributional effects. The literature has largely identified 2 principal channels of distributional effects, the income channels and the wealth channels. The income channels basically relate to households' heterogeneity depending on the sources of income or the income composition channel, whereby different people derive their income from labor versus capital and transfers. And so to the extent that the capital income is much more sensitive to monetary policy in business cycles, we would expect that the monetary policy action would have an inequality increasing. The second box in my presentation, your earnings distribution channel, whereby the wages and employment of those workers at the bottom of the overall wage distribution are much more sensitive to monetary policy shocks versus those at the top. So a monetary policy action, easing action, would actually be inequality reducing. And then there are 2 different principal wealth channels that we also would like to cover and identified in the literature. These are the balance sheet channel and the fact that the different households have different composition of their both assets and liabilities. In terms of types and mature assets would be affected differently from the same monetary policy actions. The final principal channel covers the so-called savings redistribution. whereby households differ in terms of the overall size of their net wealth. The savers, or those with a positive net wealth, particularly those invested in fixed income instruments, versus the borrowers who have also negative net wealth. So if you can imagine, the same policy easing action that would result in the lower interest rate would help and benefit the borrowers and hurt the savers. So these kind of heterogeneity in terms of household income and wealth characteristics, we call them exposures. And these are because this shows how different households are exposed to the same macro policy shock. However, the overall effect of monetary policy on inequality consists of yet another layer, and here you can see the bottom of the slide, which is the effects on the feedback or the general equilibrium effects through consumption and investment, for instance, employment and labor income, and current and financial accounts. And in turn, this overall impact would also depend on different sources of heterogeneities. For instance, whether the agents are constrained would obviously determine their consumption and investment plans. For instance, whether the workers are skilled or unskilled, they will be also affected differently, and whether firms operate in tradable versus non-tradable sectors. So this is all model-based that would help us identify the overall effects. Now, with this conceptual framework that is grounded in the literature in mind, we now continue looking into the exposures of monetary policy shocks. And we begin with the first exposure that stems from households' heterogeneity based on income composition. Now, looking at the left chart, what we show here is that households in different OECD countries derive their income from labor earnings, transfers, and income from capital. The share of labor income and transfers vary significantly across the OECD countries, particularly at the top. You could see the fifth quintile. This is the top quintile. And here, just to explain that this reflects difference in the relative importance of capital income, the concentration and composition of wealth. For instance, in the US, capital income is especially concentrated at the very top, particularly the top 1% and top 10% of the income distribution. In the euro area, rich households are also more likely to derive a higher share of income from capital as they hold more financial assets, while households at the bottom benefit from relatively more generous transfer system. So on the right, we would like to illustrate the exposure to earnings distribution channel. Basically, in OECD countries, workers at the top, at the lower end and the middle of the earnings distribution face higher unemployment risks than those at the top. And so over 2019, for instance, unemployment among young workers that earn less on average has been much more volatile. You can see it at the top part of the quadrant, compared to those of the older workers that typically earn more, indicated that the young face much higher unemployment risk as their employment is more sensitive to economic cycle. And even worse yet, in many of these countries where youth unemployment is a lot more volatile, they also face very high average youth unemployment rate. So by stimulating demand and reduction in unemployment, monetary policy would benefit relatively more earners at the lower end of the distribution, given that they face higher unemployment risk, improving the distribution of consumption and income in turn. This was the principal channel highlighted by Draghi and the euro area and the United Kingdom. And of course, from this perspective, the high volatility of unemployment and the high level of unemployment of the young was particularly an issue in Italy as well. Now, next type of exposure that we would like to illustrate, going through our schematic, this actually focuses on the balance sheet channel. So in this particular slide, we show data from, these charts are based on microdata for the United States on the left and the European Union on the right, which is largely euro area plus a few non-euro area EU countries. So what are the exposures through these channels in the United States and the EU? As you can see here, at the top, in the United States, the most important asset is equity. So the wealth is dominated by equity, and the red bars and the striped bars, which is bonds. So overall, this makes up for more than 60% of total assets. The liquid assets, which you could see in the orange color here, are much smaller in the United States compared to Europe. And this reflects the fact that in Europe, there is a greater reliance on bank-based financial intermediation as opposed to a capital market-based financial system in the US. And finally, the largest asset for most of the household is basically real estate, which is the blue bar, which you see in the United States for the bottom and middle, bottom 20, middle 70%. And then in Europe, you see a much larger share on both blue and gray bar. The gray bar being the secondary market real estate, which is more like a saving vehicle in Europe. And you can see that particularly the wealthy have a fairly large share of secondary real estate in their portfolio. In terms of liabilities, an interesting point to make is that by far the largest liability is the long-term nominal mortgage debt. And so the way the monetary policy shock would affect liabilities to the extent that it lowers the debt service, lower interest rate would lower the debt service and therefore increases disposable income of the households. Now with this illustration of exposure, we will now move into the fact that the same household is typically exposed to several channels, which may have offsetting effects, and we would like to showcase this. And then in the next few slides, we'll quantify some of these channels and put different channels together to assess the overall distributional impact of monetary policy. Let us channels. So we basically have a simple simulation that shows the direct effect of a fall in interest rate. Two charts illustrate potential gains of 100 basis points using households' unhedged interest rate exposures, which are computed based on maturing assets net tension following the work of Auclair, and similar work has been done for the European Union as well. The findings are in line with the literature, but of course the precise magnitude is sensitive to the assumptions. These illustrative gains and losses are shown to vary by broad social classes and age cohorts to account for the individual's life cycle. And so what you see here is basically breaking them down by the younger and the older persons, prime age and younger, and then by bottom 20%, middle 70%, and top 10% of the distribution. And so what you see is that the poor, both younger and older, and the younger middle class in the United States, they would tend to benefit from a negative interest rate shock, negative in a sense, a drop in interest rate, which is associated with monetary policy easing shock. And these are the same households that have a negative unhedged interest rate exposures. On the other hand, the middle income older households and the top 10%, both young and old, would tend to be disadvantaged from the interest rate fall. And we are speaking about households with positive unhedged real interest exposures, which would mean these are households that invest their savings predominantly in the fixed income instruments. And you could see that the similar story emerges also for Europe as well. However, so in a way, through these channels, monetary policy easing shock would tend to improve inequality. However, this is not the whole story, and as we recall from before, there is an important other channel, which is through the capital gains of the risky assets. And here we have stocks, real estate, and bonds. So here we do another micro simulations where we illustrate the impact on wealth of different households from monetary policy-induced increase in asset prices. To this end, we have a simplifying assumptions, and we just calculate the mechanical impact of a 10% increase in equity, housing, and bond prices on the distribution of capital gains relative to net wealth. And so a few conclusions that emerge from these charts. Again, we do the same thing for the United States and for the European Union. These are aggregated data based on microeconomic survey data. So number one, what you see here is that the top 10% or the rich household benefit, particularly in the United States, benefit a lot from the monetary policy easing action through the higher prices of equities. Number two, oh, sorry, I went through the next slide. Number two, of the real estate prices. Since recall that many of the households at the lower end of distribution invest in real estate, and particularly also in Europe, you see some positive capital gains from the rising of the real estate prices. Of course, there are caveats here that should be mentioned. Number one is that since these capital gains are scaled by the initial level of wealth, even the very tiny changes, especially at the bottom of the distribution, could look large in percentage terms from the very low level of net wealth at the bottom of the net wealth distribution. And of course, the ownership status of individual households matters as well, whether they tend to hold more real estate or not. And then finally, the bond price capital gains, which is described areas here, you see that these are fairly equally distributed across different households and not so important in Europe. So with this, I give the floor to Chiara, who is going to walk you through different modeling exercises and then how we put together the different effects to come to a conclusion about the overall net effects as well as the policy implication. Thank you. So Chiara?
Thank you. So the leitmotif in this presentation is that there are many different channels. These channels depend on the type of assets held by different households. They depend on the initial conditions of the economy. They even depend on the structure of the economy, so that different channels may have varying degrees of strength. And the big question is, all of these channels may or may not net each other's out, so that what can we conclude on what is the overall effect on of monetary policy shocks on the distribution of income, of wealth, of consumption. So one attempt to try to answer this question is by using a model. We put together some of these channels in a DSG. This model is based on Kaplan, Moll, and Violante 2018. It has heterogeneous agents and two types of assets, short-term and long-term, and it is calibrated to the US. So we won't go into the details for the sake of time, but it's worth knowing that we calibrate the model to the US economy according to three different dimensions: the inequality of wealth. So we try to capture inequality in net wealth, inequality in asset holdings, and inequality in labor earnings. So these three dimensions of heterogeneity then will allow us to try to highlight the relative importance of income composition channel versus savings redistribution channel. And then we ask, what is the effect of a monetary policy shock? And in this slide is presented an impulse response function following a loosening of 100 basis points in the Fed fund rates. So, the three charts present income inequality, net wealth inequality, consumption inequality. And the first thing that appears clear is that the black line is the net effect, the first thing that comes very clearly is that depending on what, I'm sorry, Nina, are you still showing the slides? I think, can you still see the slides, or am I the only one that lost them? No. Okay, let me put them on 1 second. Okay, sorry. Can you see them now?
Yes, of course.
Okay, thank you. Sorry, 1 second. So the first thing that comes, the first thing that is obvious is that depending on the type of measure looked at, whether income inequality, wealth inequality, or consumption inequality, the answer from the model changed dramatically. In particular, the model suggests that income inequality rises following monetary policy loosening because rich benefit from higher returns to assets, but these effects are short-lived, given that the monetary policy is also a short-lived shock. Wealth inequality is roughly unchanged. Now, why is that the case? This is a combination of numerator and denominator effect. The average household holds assets worth 3 times their income, but at the top of the wealth distribution, the asset to income ratio is larger than at the bottom of the distribution. So wealth at the bottom is very responsive to increases in income, while wealth at the top, it is not. Finally, the right-hand side chart is about, says that consumption inequality actually falls. Now, why is that the case? It's because people at the lower end of the distribution tends to consume a disproportionately larger share of their income, so that when they have higher wages, they're going to consume disproportionately more than richer households. Now, this model could put together some of the channels, but definitely not all. In particular, it does not capture the feedback through the extensive margin of the labor earnings. There is no unemployment. There are other papers that explore this crucial channel that is not explored here. Another important caveat is that in this model, wages adjust flexibly, but prices do not. So this is going to have an impact on the results. Now, in order to highlight the role of the extensive of the effect of the monetary policy shock on the labor market, I'm going to show you a couple of results on the extensive and intensive margin. This is using a combination of method, local projection and distributed lag model. But the overall message is that while the labor market, the effects on the labor market are a combination of 2 different effects. On the one hand, the unemployment decrease following a monetary policy loosening. So this has a positive impact on inequality through the labor market, through an earnings channel. But we also observe that conditional on remaining employed, high income earners benefit relatively more from a monetary policy loosening than low income earners. And the effect of the combination of these 2 effects offset each other and has opposite effect. So what are overall the policy implications from this? We don't we observe empirically that there are many different channels that the monetary policy may have an impact, but all of these channels offset each other. So overall, we believe that monetary policy should remain focused on monetary policy stability. Why? Because burdening monetary policy with more objectives might undermine its effectiveness. And also, monetary policy is not the only tools that policymakers have. In the chart in this figure, we plot the role. We use again the same model as before, and looking at what happens when we include also the possibility for counter-cyclical transfer from the government, suggesting that coordination with the fiscal policy might improve the trade-offs faced by the central bank when conducting monetary policy. Also, it's very important for central bank to clearly communicate their objectives. And this is going to be key in order to address public concerns regarding distributional issues of monetary policy. And this is indeed something that the central banks all over the world have pursued more and more in the last years, as concerns on distribution have increased. It's important again to emphasize that monetary policy is a blunt tool to address, too blunt to address group-specific concerns. Finally, any distributional effect that monetary policy may have can be mitigated by policies designed for this purpose. So redistributive fiscal policy, address skill gaps through labor market policies, education reforms, and promote access to financial markets. So, so this is the end of our presentation, and we are happy to discuss if any question you may have. Thank you.
Yeah, thank you very much, Chiara and Nina, for an excellent start. I think the floor is for Marco Bernardini for the second paper. Thank you, Marco.
Hello, everyone. Just one sec that I put on the slides. Yes. Okay. Here it is. Can you see the slides?
Yes.
Yes. So thank you very much for the invitation. So this is joint work with this is joint work with Annalisa De Nicola, also at Banca d'Italia, and the usual disclaimer applies. So these are our own views and do not necessarily reflect those of Banca d'Italia or the Eurosystem. So let me first say what this paper is about. So in this paper, we investigate the dynamic effects of the purchases that were implemented in Italy during the COVID crisis, and in particular in the government bond markets. So the reason why we do that is that we want to provide an assessment of the so-called market stabilization role of QE that I will explain just in the next slide. And just let me say that concerning the empirical framework that we use, this is based on two main pillars. So on one end, we are going to achieve identification by using high-frequency data that are of confidential nature. And we are going to compute dynamics with local projections that I see that also the previous paper, and I think also the next one, are using. So we contribute to the literature on QE, especially on that strand of the literature that focuses on the implementation of QE. So much of the empirical evidence of QE comes from official communications, so official announcements, but less is known about flow effects. So those effects that are associated with the actual purchase, the actual implementation of a program. And this is mostly due to the fact that I mean, it's not easy to get access to this data, so there is just less evidence. So what we are going to do in this paper, we are going to take advantage of the unprecedented variation in the data to learn more about this aspect of QE, the actual implementation of QE. So we have two main policy implications from this paper. So the first one is that actual purchases matter over and above purchase announcements. So this means that either if you are a policymaker or you are a scholar, if you want to know more about QE, you have to also look at the implementation of the program. So looking at announcements is very important, but it's not enough. The second implication that we find is that the effectiveness of QE can be improved by applying a state contingent implementation of the program. That means that you should have the flexibility to increase the pace of purchases very quickly in bad times and maybe reduce it in good times for a total funding that remain fixed. So let me just recap very quickly what was the response of the Eurosystem in terms of QE to the COVID crisis. So in March 2020, the Eurosystem first increased the size of the existing program, the APP, and then a few days later, it launched the PEP, a brand new program that currently it's at around 2 trillion euros. So what makes the PEP special is the role of the PEP that is a dual role. So on one hand, with this program, we want to provide additional accommodation to close the inflation gap that was caused by the pandemic. So this is just, you know, the Taylor principle, the Taylor rule. So inflation goes down, you want to provide more accommodation, okay? And here you can think that the main tool is the overall size of the program. So if you see here at the figure, it's like the orange line, is the size of the pie. But this program was also intended to serve an additional function that is called the market stabilization role or function. And here the idea is to use this program to stabilize the financial markets with the goal of safeguarding the transmission of monetary policy. So monetary policy is a very indirect tool. You start by affecting rates. You hope to in this way to affect inflation, but this takes time and you need a transmission mechanism. And if markets are unstable, you will never be able to reach your inflation objective. So the way we did it, I mean, the way the PEP was designed was to achieve this by having a flexible implementation of the program. So look again at the figure here, that is that once you have decided the size of this pie, you have still to decide how to eat the pie. And so you have to decide how to cut the slices out of this pie. This means how to distribute purchases over time, how to distribute purchases across different assets, for instance. And this was, you know, the particularity of this program. And in this paper, we are particularly interested in this second aspect. So we are not going to disentangle the two, but we are going to provide evidence that would allow us to understand more this second role of QE, the market stabilization role. So this is a paper that focuses on the Italian government bond market. So in this paper, we claim that the Italian government bond market provides an ideal case study to study the implementation of QE. So this was one of the hardest hit markets by the pandemic. So in this figure here, you can see the evolution of two financial conditions in this market. So the first is just a measure of sovereign risk, the red one, the difference between German and Italian bonds. And the green line is a measure of market illiquidity that is constructed internally here at the bank using confidential sources. So what you can see here is that at the beginning of March 2020, actually these two conditions these two indexes were really going up. Okay, so financial conditions became very, very tight, and only after the announcement of the PEP, the ECB was able to partially stabilize conditions in this market. But what is very interesting about this figure is that financial conditions remain much tighter than before the pandemic for several months. It was only at the end of the summer here that we were able to stabilize completely this market. So this provides us a lot of variation in the data to understand to what extent also the implementation of the program, that of course comes after the official announcement, was partly responsible for this stabilization in the market. So if you are interested about these questions, you have a big problem. And the problem is that you are interested in the relation that goes from purchases to yields. That is probably a negative relation. You increase purchases, this lowers yields, but you have also an opposite relation where the causation runs from the opposite side, and also the sign of this relation is different. So just to give you an example, if you're in the middle of a crisis and yields go up, I mean, central banks are ready to intervene to increase purchases with the goal of stabilizing the market. Okay, so the fact that there are these two relations, this can confound your estimation. So if you just run simple regressions, you might get very weird results. So we address this bias in this paper by using high frequency data. So we are going to use data that were sampled at 5 minutes intervals. And these allow us to make the following identification assumption. So we are going to assume that central bank portfolio managers, that are actually my colleagues that actually implement these purchases in the office desk, they need at least 5 minutes to react to shocks that put upward pressure on yields. So they are very, very reactive, but they need at least a few minutes in order to execute the trade because they have to perform a set of due diligence activities. So we are going to exploit this policy lag to identify the green relation here and get rid of the red one. So this was the first pillar of the empirical strategy. The second pillar is that we are going to estimate dynamics using local projections. So I will not cover technically what the local projection is. I just want to say that this is a method that has been used extensively. I've also extensively used in my own research in previous years. And these allow us to estimate an impulse response without estimating how the economy works. That is normally what you do in VARs and DSGs. You estimate how the economy works, and then out of it you extract an impulse response. Here, what you're doing, if you are directly estimating the impulse response from a practical point of view, these allow us to estimate very complex objects with very simple and standard methods. So it gives us a lot of flexibility in what we can achieve. I will not get into technical details. If you're interested about it, just give a look at the paper. We explain very carefully what we do, and if you have questions, just drop an email. So let me go straight to the results. So this is one of the main figures of the paper. So what you are looking at here is what happened on average during 2020 when Banca d'Italia was buying, in this example, long-term bonds. Okay, so let me comment figure by figure. So here, what you see is that when we buy long-term bonds, what we observe is an immediate compression of long-term yields. And more importantly, what we find is that yields remain compressed also in later periods. So this means that not only we observe effects that are associated with the actual implementation of the program, this effect tends to be persistent. So this is important because what you're looking at here, this is just a purchase. Over the day, we do several purchases. So this means that when you're doing the next purchase, it's very likely that in the market, you're still observing the effects associated with the previous one. So once you sum up all these effects over the day, well, it's very likely that the simple implementation of the program is helping us to stabilize yields further and on top of what you already achieved with the announcement of the program. Another result that we find is that in this example here, we are focusing on the purchase of long-term bonds, but we do observe that also short and medium-term bonds are actually reacting to the purchase. So this makes sense. This means that these assets are kind of, can be substituted to a certain extent. We also find that 10-year bond yields are reacting more than 5-year yields. So you see this here. This is the difference between 10 and 5, and you see that it's negative. So this means that when we purchase long-term bonds, we are actually able to immediately shift down the yield curve and also flatten a little bit the yield curve. So this is something that we have in mind about QE, but we normally observe upon announcement. Well, we do get very similar results also if we look at the actual implementation. Let me also comment on the two indicators that I shown you before. So let me go back very quickly. So these two indicators of financial conditions, the first one was sovereign risk. The second one was market liquidity. We actually try to understand to what extent the purchase is able to affect these two conditions. So what we find is that the purchase of long-term bonds, in this case, is able to compress sovereign spreads. Actually, what we find is that the reduction in the yield curve is almost entirely driven by compression of this credit and liquidity risk premium. Moreover, and this is a very, let's say, novel result of this paper, we do find that the intervention of the bank tends to improve the liquidity in the market. So at the impact, you see nothing happens because, if anything, the bank is extracting supply from the market. But in the subsequent periods, what we do observe is that the liquidity tends to improve. So this can be interpreted by the fact that the intervention of the bank gives confidence to the market, and this tends to improve market liquidity. So overall, these results shows that the implementation matter. You have this extra effect that are on top of what you already obtained at the announcement. But what you have seen here, these are averages effects over time. So as such, they might change over time. So what we do next is that we are going to investigate this guy here, so the impact of the 10-year yield, but over time. So we get we use the richness of our data, and we are going to estimate rolling windows here. And what we do find is that, and this is actually an important result of this paper, is that in bad times, flow effects are much stronger. So what you can see here in that is bad times when the spreads were very high, liquidity in the market was very poor. I mean, the flow effects were like 2 times as much as in good times. So the size of this elasticity is around 10 basis points per billion. That is a lot, and is 2 times as large. And in good times, that was 5 basis points, 4 basis points as much. So this result is very robust. It was quite striking because we get exactly the same result also if we look at different type of purchases. So it's something that is really in the data. And moreover, the size of this difference is even conservative. So I will not cover this because it's linked to the technical part of the paper. But given our identification assumption, we can claim that this difference is just a lower bound. And probably in reality, the effects are much larger in bad times. From a policy point of view, I mean, this result is very important because this result is telling us that given the size of the program, let's say that this size remains fixed, you can improve the effectiveness of QE by simply doing a temporary distribution of these purchases. So simply by buying more in bad times and buying less in good times, if you want to keep the size fixed. So by just doing this reshuffling, you can increase the effectiveness of the program. So this is also saying that from a policy point of view, you really want to have some degree of flexibility when you are implementing QE, because you want to have the ability of increasing the pace of purchases very quickly if the market is unstable. So this was just the yield impact. Of course, this is a very interesting result. So what we do in the paper next is to define a state-dependent version of our model in which we define an indicator of market stress. Very simple, it's just a dumb indicator that allow us to investigate the whole transmission that you saw before in bad as well as in good times. So these are the results. So let's start from with the case of bad times. So what we find is that in bad times, it's not just the yield impact that is much stronger. So it's the whole transmission that is stronger. So what you can see is that at the height of the crisis, so this is more or less in March, at the height of the crisis, you can see that the reduction in spreads and the improvement in market liquidity was just very, very, very strong. But what is very interesting about this exercise is that when we look at good times, what we find is that it is true. These effects are smaller in size, but still we find that they are different from zero, and the transmission operates very similarly. So we do observe a flattening of the curve, we do observe a compression of spreads, we do observe a slow improvement in market liquidity. So this means that the implementation of the program probably is very, very important in bad times, but also in good times, you can get additional effects when you simply are applying, you are implementing the program. So let me conclude here. I think that I'm on time. So from this paper, I personally learned two main lessons. So the first one is that the way QE is implemented matters. So if you are a policymaker that have to decide about these policies, or you are a scholar that you are investigating about these policies, well, you should take into account also how these purchases are implemented. This makes a difference. So of course, the announcement of the program is very important, probably is the most important dimension, but you really need to take into account the implementation if you want to get the overall effect of this type of tool. The second lesson is that, as I told you just now, is that the effectiveness of this program can be enhanced by allowing the purchases, the pace of these purchases to be time varying. So you'd like not to have a strict implementation of these purchases, you would like to have the ability to vary the pace of these purchases according to market conditions. By doing that, I mean, this is free, you can improve the effectiveness of this policy. So let me conclude by also saying a little bit what we are doing now in the bank, especially in my team. So this was a paper where the main goal was, this paper was written at the peak of the crisis. So at the time, the idea was to write down a model as simple as possible, just to exploit the data and understand what was happening. So the analysis, if you read the paper and cover the technical part, it's really simple. So we want to provide a set of robust and agnostic estimates. This is very important because this means that everything that I shown you to you today, I mean, it's really in the data. Okay. Of course, this is the benefit. The cost is that you are a little bit limited in what you can do. So what we are doing now in parallel work with a different co-author, we are building a more structural empirical model that we feed with this evidence. But the benefit of imposing additional restrictions is that we are able to evaluating the total effectiveness of QE. So we are trying to sum up all these effects over time. It's not easy, but we are trying to do that. And once we have these estimates, we are trying to construct policy counterfactuals in order to answer the question on what was the total effectiveness of this program, how did contributed to the level of market rates, the volatility, and inflation. So that's it, and I'm happy to answer questions if there are any in the QA session. Thank you.
Thank you. Thank you very much, Marco, for explaining in a very clear manner, very technical and complex empirical evidence. And the floor now is to the ECB paper, is the last one in the session. And then we can turn to the question and answer. Francesca, the floor is yours.
Hi, good afternoon, everyone. So I will try to share my screen now. Let me know as soon as you see my slides. So you should be seeing them now?
Yeah, we see them.
Okay.
Thank you.
Okay, so I will put them in full screen mode. Are they visible in a nice way? I hope so.
Yes.
Okay, great. So thanks a lot for the opportunity to present this paper. which is joint work with Carlo Altavilla, Miguel Busini, and Lorenzo Burlon. We all work together at the European Central Bank in the Monetary Analysis Division. And of course, the usual disclaimer applies, so the opinions in this presentation are those of the authors and do not reflect necessarily the views of the European Central Bank. So let me start with, let's say, an overview of what are our questions and what will be the main results that I will present in this paper. So we try to answer two main questions. So has banks' intermediation capacity been affected by the policy response in the wake of the pandemic crisis, of the COVID-19 crisis? And then the second, and what we consider also a very important question, is whether the coordinated nature of the pandemic response policies actually triggered an amplification effect above and beyond the impact of the individual announcements and implementation of policies. So in the paper, in what will follow in this presentation, we find that in the absence of the targeted longer-term refinancing operations, the TLTROs, one of the main instruments of monetary policy that was recalibrating during the crisis, lending to firms would have been significantly lower. In addition, we find the capital relief measures supported banks' intermediation capacity, and that the policy coordination between the two, between monetary policy and macroprudential and supervisory authorities that granted some capital relief to banks, produced an amplification effect on lending. And then, as a last exercise, actually, we provide some estimates to, and we find that the policy responses actually avoided a potential contraction in firms' employment. So I will first show some stylized facts and describe the pandemic response policies, and then I will present our results. So regarding the main stylized facts that I want to introduce briefly, also to highlight the magnitude of the shock, of the pandemic shock. The title of our paper actually comes from the period of containment measures that were required to contain the spread of the COVID-19 pandemic, and that has started to be referred to as the Great Lockdown. And indeed, the tight restrictions that were imposed at the beginning of the crisis in spring 2020 had a severe impact on economic activity. And this is visible in the left-hand side chart of this slide, from both hard data, such as the growth rate in industrial production, as well as soft information, such as PMI indicators, which collapsed at the peak of the pandemic in spring 2020. This fall in business activity had a direct impact on firms' revenues and also on their creditworthiness. And this actually reverberated directly on banks' balance sheet via increased credit risk, which, together with the uncertainty and the risk aversion,
Francesca, I cannot hear you. I don't know if others have the same issue.
Neither can I.
Oh. Okay. Okay. Is she the only one for some reason muted, or also others? So who can hear me at the moment?
I can.
I can.
I can as well. Nina here.
Yes, me too, I can. I don't see her anymore in the
Yeah.
panel.
She's also muted, though.
Maybe she's trying to rejoin. Okay, let's do that. Okay, presumably she will. She may have a connection issue. She may be trying to rejoin. I have a few questions. So concerning Chiara's and Nina's first presentation, what was in your view the possible impact of the extraordinary policy responses undertaken during the COVID-19 pandemic, the coronavirus crisis, on income and wealth inequality? And will some of these impacts be persistent or will they be temporary? So what is your view on that? Concerning Marcos, very okay. Francesca, are you back? Okay. All right. Okay, concerning Marcos' presentation, how do you define good times versus bad times? Are they defined in terms of the acutization of the sovereign spread between German and Italian bonds? Do you use the keys, the composite indicator of systemic stress, the one elaborated by Hoffman, Kramer, and other ECB authors? So how do you define good times and bad times? First question. Second question, what was the impact of the European Council meetings? We saw that there were many meetings every couple of weeks in February, March, and so forth. And they initially they were inconclusive about a joint fiscal response, which is also what Rainer Masera was mentioning earlier on. But then discussion on the what became the NGEU started materializing, in addition to 3 safety nets. So in your apparatus, can you tell the impact of this joint pan-European fiscal response on Italian spreads, in addition to the importance of actual implementation of PEP and APP purchases? Thank you. So I know that there are some technical stuff that should help us.
So maybe the colleagues from the IMF can answer the first question, and then I will answer the others.
Yeah.
Okay. I think that in answering your question, I would point to 2 issues in particular. We haven't done analytical work specifically on COVID yet, but through the lens of our framework, I think it's important to point out 2 effects. One is the effect on unemployment. I think that there is also a lot of research to be done on the extent to which unemployment spells may have permanent effects on individuals' career patterns. So, so the support of the monetary policy support in the labor market through this channel might have been particularly important. And might have also have a permanent effect, a long-lasting effect, to the extent to which labor market events have long-lasting effects on unemployment outcomes. The second point that I wanted to make was to link your question to the discussion that was raging last year on the real financial divide, on looking at employment numbers on the one hand and looking at the situation on financial markets. It is still an open question. The role that monetary policy played in that aspect by providing liquidity in financial markets, and so to the extent to which monetary policy did play indeed a role, then this would be an important channel through which monetary policy had impact in worsening inequality during COVID. But again, like following a bit the leitmotif in the paper, like what was the overall effect? This remain an empirical question that will need to be tackled in future research.
Okay, thank you very much, Chiara and Nina.
So I can try to answer your questions. So thank you for the questions. So the first one was, how do you define good and bad times? Well, we use a very simple definition here. We are actually looking at the top, this part of the distribution of these two indicators that you saw before, so sovereign risk and illiquidity. But what I want to say that maybe it's more interesting is that what we do see in the data, if we look at correlations, is that the liquidity in the market seems to matter more than the spreads, so the size of sovereign risk. However, we don't have enough variation in the data to formalize this result, and this is something that in the conclusions we say that it would be very interesting to investigate further. So what are really the drivers of these time variation in the effects, if it's just the liquidity in the market, or if there are other conditions that might drive these differential effects. Concerning the second question, it is also very interesting. Of course, these type of discussions were very important for the level of market rates. So in this paper, what we do is that we really ignore them. So we make sure that these type of events that, of course, affected market rates are not affecting our estimation. So we are confident that there is no type of bias, but we are not focusing on them. But in our current research with another co-author, we are actually developing a model that, ideally should help us to sum all these type of effects in order to have an idea of what was the overall effects also coming from these other type of channels. Thank you.
Okay. Welcome, Francesca.
Hello. Hey, can you hear me? So actually,
yes.
Given that I had a full screen, I'm not sure at what point actually my presentation was interrupted, because I couldn't, I didn't get a notification that I was kicked out. So let me try to share again my presentation. I'm sorry for this inconvenience. Let's see. Okay, so until which point where did you manage to hear me?
I think it'd be prior to this, a bit earlier.
Okay.
A little bit earlier.
Here.
A little bit earlier. A little bit earlier. A little bit earlier.
But then, so you didn't hear anything?
Yeah. So here, you had completed the description of this slide.
Ah, okay. I'm sorry. So you really missed. Okay, so I will run a bit late in the presentation, because I didn't receive any message that I was out. Okay, very good. Okay, so this was just to show the magnitude of the shocks, and then I was showing the outline, because we in the paper we focus on the monetary policy interventions, on the macroprudential and supervisory measures, and then I will present the results. So. As for the monetary policy, we know that the pandemic response revolved around two main tools. So one was the liquidity providing operations in the forms of targeted long-term refinancing operations or TLTROs, and the other were asset purchase programs that also Marco mentioned in his previous presentation, in particular the PEP. So in the paper we focus on TLTROs, which embed incentives for banks to provide lending to the real economy, given their targeted nature. And in particular, the TLTROs were recalibrated in March and April 2020, and this was pivotal to enhance their accommodative potential, because the maximum amount that banks could borrow under the program was increased. Also the pricing was made more generous and could actually go below the deposit facility rate. And as a result, in June 2020, the amount that banks borrowed was huge, like 1.2 trillion, and this is the peak that you see in this slide, the light blue bar in the chart. Then, regarding the macroprudential and supervisory measures adopted in the crisis, where a series of temporary measures were introduced, and these were aimed at sustaining banks' ability to keep funding the real economy and to actually increase the risk-bearing capacity amid the uncertainty and the pandemic. So without going into the details of the individual policies, but I just want to mention what will be important then for the development of the paper and the results, is that taken together, these measures released around 1.5 percentage point increase in banks' capital buffers on aggregate, so the capital buffer in excess of the regulatory requirement. So in what follows, then I will present our analysis on how the TLTRO and the capital measures have contributed to support the bank lending in the aftermath of the pandemic shock. So I start with the monetary policy, so with the focus on TLTROs. So we use confidential data on bank balance sheets and the liquidity operation, and we employ a local projection model to allow for a delayed response of lending to the shock in two different periods. So we have a pre-pandemic period that runs until February 2020, and a post-pandemic period, so from March 2020. So the dependent variable is, of course, the change in volume of loans to firms, which is what we are interested in. And the regressor TLTRO can take two forms. So first, it can be, in the first specification that I will show, is a measure of the actual participation in the program by each bank, so defined as the amount that each bank borrowed over the maximum capacity, the maximum borrowing allowance, or it could be the high-frequency reaction of bank bonds around TLTRO-related announcements, which we consider a more exogenous variable, a more exogenous shock. Okay, then in this slide, we show the results using the TLTRO uptake variable, so the potential endogenous one in the pre-pandemic and in the post-pandemic sample, so in the left-hand side and the right-hand side, respectively. So we find that banks that participate more in the TLTROs show an increasingly higher volume of loans compared to banks that participate less, and that the transmission is gradual, and this is normal, and it reflects the naturally delayed response of loan origination. And the impact in the post-pandemic is strikingly larger, and this can be explained also in light of the recalibration of the program, because as I mentioned before, the maximum the borrowing allowance, so the maximum amount that banks could borrow, was increased by a lot, so from 30 to 50% of the stock of eligible loans of the banks. Second, the structure of the incentive scheme, of the design, also changed with the recalibration in spring 2020 to focus the targeting of lending in the pandemic period, so in the year from March 2020. Moreover, as I was mentioning in the previous slides, like the large impact could actually reflect some degree of endogeneity in the decision to rely on TLTRO as a funding option. So with this measure of actual participation, given the extraordinary circumstances of the pandemic. So in order to address these, in a separate specification, we use as a regressor the high frequency reaction of bank bonds around the TLTRO related announcements. And again, we look look at various horizons within each period, so the pre and the post-pandemic. So on the left-hand side, on the right-hand side, in the post-pandemic period, we find that the impacts are larger compared to the pre-pandemic period. And in general, the reaction of bank bonds is associated with a stronger lending performance. And in the post-pandemic period, the results actually become statistically significant after 3 quarters, so at the 9 months horizon. So, this result is somehow reassuring that this more conservative, let's say, specification using a more exogenous measure still corroborates our result on the impact of the TLTROs on lending. Then in the next slide, and very quickly, I just wanted to mention an additional robustness that we do to control for the concomitant policy measures that were taken at the same time, and also to control for the funding structure of banks. So just very quickly, so we use a control. We take the bank level take-up of government guarantees as a share of outstanding loans to control for the existence of the government guarantee schemes introduced by national authorities. Then the securities holding, so the holdings of securities, is a proxy for banks' exposure to the central bank asset purchase. And we use excess liquidity holdings to capture, let's say, the potential exposure of banks to the negative rate policy. And then in the last column, we add also some controls for bank funding structure to account for the fact that this might have evolved also in parallel to the impact of the TLTROs. And all the results on the impact of TLTROs actually appear to be robust to the inclusion of these controls, and therefore this is also like reassuring on our main analysis. Then finally, what we do on this part on monetary policy, we just rescale and annualize our coefficients on the impact of TLTROs on loan, and we put it in the overall range of estimates explored by previous studies. And the vertical dotted line is our estimate on the pre-pandemic sample, while the solid line is the one on the post-pandemic sample, and we see that they fall, let's say, within the range of previous studies. Then we move to the analysis of the impact of macroprudential and supervisory measures in isolation from monetary policies, and we illustrate how the behavior of banks hit by a change in their capital requirements varies, distinguishing here between banks that had a mid, low, or high level of capital buffer before the shock. So we used the same sample of banks. We integrated here with confidential data on the bank level capital requirements. And again, we focus on the two sub-periods of the pre-pandemic and the post-pandemic. And the post-pandemic, we can actually exploit the actual capital relief that I mentioned before from the measures adopted in spring 2020. So the dependent variables, again, is the change in lending to firms. And our coefficients of interest are here on the interaction between the capital relief shock and dummies for mid, low, or high level of capital buffers before the shock. So for banks that had capital buffers between the 25th and 75th percentile, so the mid, or below the 25th percentile, or above the 75th percentile of the distribution of buffers. So in the next slide, I report the results, and the coefficients on the first row of each table show the results for banks with intermediate levels of capital buffers. So focusing on the post-pandemic result on the right-hand side, we can see that actually these banks benefited the most from the capital relief measures adopted in the post-pandemic, and the impact is particularly strong at the 6 months horizon actually. So. But why is it the case? So the stronger reaction of banks with intermediate buffers compared to banks with low buffers that are displayed in the second row of the table here may be linked to the need to actually have sufficient capital leeway to be able to expand the balance sheet in an environment with a high uncertainty, such that the one that emerged from the pandemic. And at the same time, we see that the banks with already high levels of capital buffers in the third row reacted less, as for sure capital constraints were less binding for these banks. So based actually on the coefficient for the intermediate banks of 50% of our sample in the last column of the table, in the post-pandemic table, and considering the 1.5 percentage points of capital relief that was granted through the prudential authorities, we estimate that these measures may have created space for an impact of lending growth that could be as high as 2.7% after 3 quarters. And again, we place our impact within the distribution of past and existing studies, and we find, after of course appropriate rescaling, and we find that it falls within the range. Sorry. So then I move on to the analysis of the complementarities. So in the first part, I have shown that the term funding provided by the TLTROs sustained bank lending volumes in general. The question is now whether this is particularly true when banks can actually rely on their ability to leverage up. So we therefore focus on the interaction of the TLTROs with capital availability. So the focus here is on the post-pandemic sample. And we run a model in which the dependent variable is again the change in loans to firms issued by each bank between months, the months before and the months after T. And the TLTRO regressors can take again 2 forms: the potential endogenous TLTRO uptake or the TLTRO shock based on the high frequency reaction of bank bonds. The capital buffer is again the difference between the CET1 ratio at T-1 and the capital requirement in T. What we are interested in is the coefficient on the interaction term between TLTRO and capital buffer, which in this specification appears to be always positive and significant. But let's say focusing on the last 2 columns of the table, we can see that this is also robust to the inclusion of the controls that I mentioned before, that control also for the existence of the concomitant policy measures and the funding structure of banks. And again, so considering the estimation in the first column, we find that each percentage point of additional buffer is actually associated with an increase of around 25% in the impact of lending volumes coming from TLTRO, which is just obtained by taking the ratio of the 2 coefficients circled in column 4. So the results therefore suggest that there is the complementarity between the funding cost relief that was provided by the TLTROs and the risk-bearing capacity that was provided by the capital relief measures had an amplification effect and an amplification impact on loan growth. Then, as a last exercise, we wanted to actually investigate the potential real effects of the pandemic measures on firms' behavior, and in particular on employment. So in order to do so, we match firm level data with bank level data using Bureau van Dijk's Orbis and the sample that we had before in the previous bank level analysis, and we link each firm with the banks with which they are associated using the information that is provided by Orbis data. So, given that the policy shocks actually occur at the bank level, but here we are interested in the developments in employments at the firm level, we associate to each firm the average shock experienced by the banks connected to that firm. So for the TLTROs here, we use the bank bond yields reactions around the TLTRO-related events in 2014, and the change in capital requirements introduced in January 15. So here the sample is the pre-pandemic sample, and it's annual data, of course, because we don't have in Orbis we don't have data after 2018 at the moment. So we allow for a delayed response within 4 years, and then we take our results as illustrative, let's say, of the impact given the size of the funding cost reliefs and the capital reliefs experienced during the pandemic. So in slide 22, I illustrate the the impact on firms' employment of a one standard deviation shock for both the TLTRO's announcement on the left-hand side and capital requirements on the right-hand side at different horizons. So what we can see is that the effect of TLTRO-related shocks stabilizes after the second year, while the capital shocks take more time to accumulate. And so, as I mentioned, given that we are working with a pre-pandemic sample, these impacts are illustrative for the current junction. And considering the funding cost relief and the capital relief experienced by the banks, the overall impact of the pandemic measures, actually, we estimate that it bears the potential to forestall unemployment decline in the corporate sector over 2 years, between 2020 and 2022, of 1.7%, which, with the back of the envelope calculation that we make, would be equivalent to more than 1 million workers. So, just then to conclude, to wrap up, in this paper we show and we confirm how the unprecedented policy response to the COVID-19 crisis has been crucial for counteracting the adverse economic consequences that were associated with the outbreak and the intensification of the crisis. So we use confidential data also since the start of the pandemic, and we estimate the impact of the funding cost relief from TLTROs and of the capital relief from prudential measures. And we are able to show that the pandemic response policies have somehow prevented the materialization of an adverse equilibrium that would have resulted in a substantial contraction in lending, and that the close coordination between monetary policy and prudential measures has generated an amplification effect on lending. And as I showed in the last slide, we, based on an illustrative exercise, we show that in the absence of these measures, actually, firms' employment would have significantly declined in the pandemic period. So thanks a lot. I can conclude here, and I apologize for the interruption. I hope that now you could follow me until the end, and I'm happy to answer questions if there are any.
Yeah, we did for you. Thank you very much, Francesca. Okay, let's take a few minutes for question and answer. Who would like to start?
I mean, I can.
Yeah.
So I have just a couple of questions for both papers. So concerning the IMF paper, I was wondering to what extent these effects are symmetric. So you provide evidence on monetary policy easing, but I guess that in your paper you treat easing, tightening in the same way. So in your opinion, how do you think these effects might change when you take into account the fact that the shock may have asymmetric effects depending on the sign of the shock? And the related question is also, do you think that the state of the economy might change, the initial state of the economy might change a little bit your conclusions? And concerning the other paper, I really like the paper. I mean, I work in the same field, so I know how much it's hard to provide evidence on these type of questions. And I also salute the fact that the authors try to identify this effect as much as possible, but there are limits. So for instance, they use this high frequency response of interest rates around TLTRO announcements, but in the same dates, you also had other type of announcements concerning QE rather than other tools. So I'm wondering if you thought about it, and also in this case, to what extent you think your conclusions might depend strongly on the type of identification that you selected, or they are representing a more general result. Thank you.
So maybe, shall we proceed with answers? Nina Bodina here, and then Chiara can add on the first question. So the question was whether these shocks are asymmetric, and I would want to point out that in the initial simple simulations that I have shown you, obviously the results are symmetric, right? But these are simple simulations, 10% up, 10% down increase in asset prices. However, in real world, the situation is much more different when you aggregate all of the effects together. And there has been an empirical literature on this, estimating the net effects at the IMF by Forseri and others. Of course, this is pre-pandemic, but they looked at the results for about 30 advanced and emerging economies. So when they export the impact of monetary policy tightening versus monetary policy easing shocks, what they found is some evidence for asymmetric effects. And of course, there is also theoretical grounding of that. As you recall, the impact on earnings distribution channel, whereby the low-income workers are heavily impacted in terms of losing of their potential employment prospect. This is one potential which can explain these asymmetric effects, because this has a potential to lead to much longer lingering effects and so-called scarring, and that it may affect the prospect not just in the particular time of the effect of the monetary policy, but in the longer term as well. However, in general, our work focused on just the transitory changes of monetary policy. We did not look for effect of the shocks that are more prolonged, which we may have seen now in the context of the post-COVID scarring. Our results finished much earlier than the COVID crisis. So with these caveats, yes, this has been documented in the literature that there are some asymmetric effects.
And also, if I may add, like I particularly like this question that you just asked, because there is a broad underlying policy questions of whether if monetary policy shocks are sort of like cancel each other out over time. So if you have like a little bit like the Federal Reserve errs on the up, a little bit on down, then overall, if effects are symmetric, overall, they're just going to cancel out. So it won't really matter. And so like empirical studies suggesting that actually, no, the effect is asymmetric. There are also empirical studies suggesting that the exogenous component of the monetary policy shock seem to have a larger impact than the endogenous response of monetary policy in periods of recessions. So like addressing your second part of the answer, that would mean that, so if that is the case indeed, this would push back against the idea that on the medium term, this doesn't matter. So.
Thank you.
I have a question for Francesca. If we take a historical perspective, looking perhaps at the sequence of crises, no? We have had the financial turmoil, the global financial crisis, the Great Recession, and then the Euro area crisis, and now the pandemic crisis. The exceptional response took place around 2013, 2014 with the launch of the SSM. So in a way, would it be possible to use your apparatus to show that basically the fact that we were able to deploy a monetary policy response coordinated with a micro-prudential and then have a shared role on macro-pru was really exceptional and may have played a gigantic role in actually reducing the systemic stress, the market stress that Marco documented very well in his presentation. So there is an issue of pre-pandemic and post-pandemic, but there is also maybe another paper lurking of pre-SSM, post-SSM, and that may be an exceptionally important paper, one that maybe Tommaso Padoa-Schioppa would have liked to read about, perhaps. Then another historical question to Chiara and Dina. So there is a debate on secular stagnation, declining real interest rate, declining the national rate of interest and so forth. Would it be possible to cast a national rate view on income and wealth inequality, the type of things that you are mentioning? Yeah.
I'm sorry, can you repeat the question again?
Yeah, so the question is, so you're looking at two very, very, very important aspects of the outcome of the impacts of monetary policies across the world. More or less, there is great harmonization of monetary policy responses across the main systemic central banks, no? The Fed, the Bank of England, Bank of Canada, and the ECB. But if we take a longer perspective, maybe looking at the last 20, 30 years, there is also a debate on secular stagnation, declining productivity, and the declining national rate of interest. So, ceteris paribus, what is the link between declining national rate of interest and income and wealth inequality?
So maybe we can start from this last question. As I emphasized at the beginning of the presentation, the focus on our paper was to look at the distribution of effects of transitory monetary policy shock, so the easing cycle, kind of. Now you're raising another very important question, that indeed over time and for the past decades, the natural rate of interest has been on a declining path. And obviously, the monetary policy response should not only respond to the current condition, but also should also account for this natural decline in the natural interest rate. However, this particular focus has not been discussed in our paper, and it's kind of very difficult because the link or the impact, it doesn't go just one way. Of course, if you have even lower interest rate, natural interest rate, monetary policy would have to cut rates, not just to ease the policy, but also to match the decline in the R star. But there is also another dimension going in the opposite direction, which could have some distributional effect, but also higher inequality can by itself affect the natural rate of interest.
Yeah, so, absolutely.
Yeah, and this we definitely don't take into, at least it's not the subject of our paper, but I agree this is actually a much deeper question of two-way relationship. And if I may add, again, there are structural factors that drive both trends, right? So inequality has been increasing, and the rates have been declining. And why is it so? Because maybe the rich are getting richer, they have excess accumulated savings, and the poorer, the only way to match up is to use this excess savings at the lower and lower interest rate, which means that their debt is going to increase over time. So what I want to say that these are two different dimensions that are driven by third structural factors, which are not the subject in this paper. The subject of the paper was just the monetary policy easing cycles and how they affect inequality. Yeah.
Okay. Unfortunately, I've been told by the organizer that we need to come to the end of this panel.
Yeah, can I quickly just answer maybe Marco's question that I think it was very quickly. I will be very quickly. So on the fact that we use the high frequency reaction of bank bonds around TLTRO related announcement, it's true, no, that sometimes other policies are announced, but TLTROs are very complex programs. So actually, we also use the announcements of technical details, press releases on the legal acts, which are not let's say, done on the days of the press conferences when also other announcements are made of other policies. No, so we actually have a table in the paper. This maybe we can discuss bilaterally, but I wanted to make this point. So thank you.
Very, very interesting. Thank you.
Thank you. So, so before coming to the end of the end, with my historical question, my plan was to be re-invited by Professor Paganetto next year, so we could meet again in 12 months, hopefully physically at Villa Mondragone, and discuss further this all these comments that we exchanged. I would like to thank Professor Paganetto and Rania Masera for this panel. And it's been great meeting you, discussing with you. I hope that we will keep in touch. Thank you very much. And good proceedings for the Villa Mondragone 2021. Thank you.
Thank you very much.
Ciao. A round
Thank
of
you.
virtual applauses for the presenters.
Thank you very much. Bye-bye to everybody.
Bravi.
Congratulations.
Thank
Thank
you.
you. Thank you.
Bravissimi.
Bye-bye.
Bye.
Good work.
Bye.
And Forza Italia. Okay, Giuseppe, you can end the session.
Okay. Thank Could you hear me?
Yes. Yes. Yes.
Okay. The session is dedicated to the fiscal policy in Europe, and we have the paper of Massimiliano Pisani of Bank of Italy, the COVID-19 shock and the fiscal monetary policy mix in a monetary union. That start the first paper starting. Okay, Massimiliano, go ahead.
Okay. Can you see my screen? Can you confirm?
Yes. Okay.
Yes.
Yes, is it clear? Okay, great. So first of all, let me thank the organizer for allowing me to present this joint work with my colleagues at Banca d'Italia, Anna Bartocci and Alessandro Notarpietro. And let me say that usual disclaimers apply. Okay, the goal of the paper is to examine the effectiveness of monetary and fiscal policy interaction in a monetary union in response to the pandemic shock. And to this purpose, we simulate a general equilibrium model of the euro area. I think I don't have to spend too many words in terms of motivating the paper, given the extreme relevance of the topic. And let me only say that a monetary union can be particularly affected by a recessionary shock such as the COVID-19, because this is a shock common to all member states, and because in a monetary union, normally there is a huge degree of trade and financial integration among member states. So the cross-country spillovers, in particular trade spillovers, which are the spillovers we focus on, can be non-negligible. On top of that, we have to consider that the fact that a monetary union, and in particular the euro area, was at the time that it was hit by the COVID shock already subject to huge disinflationary pressures, long-standing disinflationary pressures commonly attributed to the secular stagnation. And this COVID-19 shock would imply additional disinflationary pressures, and implying that most likely the monetary policy rate would stay at the effective lower bound for a longer amount of time, consistent with the decrease in the natural rate of interest. And moreover, the huge uncertainty associated with the COVID shock could induce possibly tensions in financial markets, in particular in the sovereign bond markets, and thus limiting the effectiveness of fiscal policy. With this respect, the institutional design of fiscal policies is key, because what we have in mind is that a safe bond, and I will be clear about what I mean by safe bond in the later slides, could be helpful in the sense of eliminating possible financial tensions associated with uncertainty and negatively affecting the effectiveness of fiscal policy. Thus, a safe bond, in a sense, if issued, could restore the fiscal policy effectiveness by eliminating, by definition, these tensions. I don't want to enter into the technical details of the paper in the interest of time. Let me only say that it's a new Keynesian model, so based on short-term nominal price and wage rigidities, and it is a two-country monetary union. So the two countries share the common central bank and have in almost all the simulations, but one, their own fiscal policies. The two countries, the model is calibrated to the euro area. The countries are labeled home and foreign, so there is no particular reference to any member state of the euro area, but they are calibrated symmetrically according to parameters, values borrowed from the existing literature on euro area modeling. Which are the simulated scenarios? First of all, let me say that we don't aim at evaluating specific economic measures adopted in response to the COVID-19 shock. What we really want to point out in this paper is how the interaction between fiscal measures on the one hand and monetary policy measure on the other hand favor the effectiveness of the policy responses themselves to the COVID shock. So the scenario COVID-19, which is the recessionary scenario, is based on a mix of large recessionary demand and supply shocks that reduce both economic activity and inflation symmetrically in each of the two regions in the euro area. And the central bank, the common central bank, given the decrease in the inflation rate, given relative to the target, given these disinflationary pressures, responds by lowering the policy rate down to the effective lower bound. So the central bank would like to reduce further the policy rate, but it cannot do it because of this constraint that becomes binding. On top of this scenario, of this COVID-19 scenario, we run a second scenario where we simulate an increase in home public transfers to domestic household and in home public consumption. The two measures last for 4 quarters, consistently with the fact that the COVID shock is not extremely long lasting. And it's a huge short-term shock. And each fiscal item is increased by 2% of before shock GDP and is financed by issuing public debt. Then we consider another scenario where the very same measures that I have just described are implemented simultaneously in both home and foreign countries under alternative assumptions. Without and with long-term sovereign bond purchase program implemented by the Central Bank of the Monetary Union for monetary policy purposes, so for stabilizing inflation, given the presence given that the short policy rate is constrained by the effective lower bound. Then alternatively, without and with an increase in the home sovereign spread, which is temporary and not extreme. So we want really to capture with this assumption the possibility of financial tensions in sovereign bond market and more generally in the home financial sectors, without trying and we do not want to describe an extreme situation like a financial crisis. It's just a temporary financial tension. And last but not least, we consider also that this fiscal measures are not implemented by national fiscal authorities, but we introduce in the model also a supranational fiscal authority that will implement the very same fiscal measures and finance them by issuing a safe bond that will not be subject and will not induce financial tensions and increasing spread. So what is the transmission mechanism behind the different scenarios? So with respect to the COVID-19 scenario, let's take it as a benchmark and reason at the margin. Higher transfers and higher public consumption raise available income and thus consumption of household. And so this would sustain aggregate demand in the home and or in the foreign country, depending if the measures are implemented unilaterally by one country or simultaneously by both countries. The central bank purchase program reduces the long-term rates and thus induces households to increase consumption and investment. This is would further sustain the aggregate demand from originating in the private sector. Let's now consider the case that there are financial tensions in one country. So there is an increase, a temporary increase in the sovereign spread in one country. In this scenario, the higher spread would reduce the effectiveness of fiscal measures. Why? Because it would be passed through to the private sector financial conditions. According to, there is some empirical evidence about this sovereign risk channel. I have in mind some paper by Corsetti and co-authors. So the idea is that in the aftermath of a fiscal expansionary measure financed in debt, the spread would temporarily increase and negatively affect the increase in private consumption and investment because of the higher borrowing conditions. And for a given fiscal shock, expansionary fiscal shock would limit the implied improvement in aggregate demand. So sovereign spread increase is passed through to private sector financing conditions. Higher borrowing costs imply a lower improvement in aggregate demand for a given expansionary fiscal shocks financed in debt. And we will show that we are able to design in the model to bypass this problem of financial tensions by including a supranational fiscal authority that would issue a safe bond, which is safe because it's backed by revenues from all countries or from both countries in the monetary union. And this safe bond would finance the fiscal measures, and there would be no spread increase by definition. And in this case, the effectiveness of fiscal policy would be restored. Of course, in the various cases in which we have an aggregate demand improvement, because we allow for trade relationship among the two member states, there would be positive cross-country trade spillover effects because of, as said, of this aggregate demand improvement. Results. So in this table, I report the home and foreign GDP implicit multiplier that we obtain in correspondence of the different simulations that I have just described. We report the implicit multiplier, that is the difference in the fourth quarter between GDP with and without fiscal stimulus divided by the size of the fiscal stimulus itself. And we report this multiplier at we compute this multiplier in the fourth quarter, because the fourth quarter is the one in which the fiscal stimulus ends, and moreover, in the no stimulus scenario, in the fourth quarter, the GDP achieves its trough. As said before, the COVID recessionary shock is a large one, but is also not extremely long-lasting. So, starting from the top of the table, the first row, in the case of home fiscal stimulus, the home multiplier is equal to 0.9, and the foreign multiplier is 0.2. So there are positive spillover effects associated with trade. The fiscal stimulus favors the improvement of aggregate demand, of home aggregate demand, and part of this higher aggregate demand is satisfied by higher home imports of foreign produced goods that favors foreign economic activity. If the stimulus is simultaneously implemented in both home and foreign countries, the multiplier, home multiplier increases to 1.1. And again, the home country, in this case, benefits from cross-country trade spillovers, because now there is a similar fiscal stimulus going on in the foreign country. Foreign aggregate demand would increase, and there would be a higher import of home-produced goods that would rise economic activity in the home country. So really, the story is about the trade spillovers effect. If on top of the simultaneous cross-country fiscal stimulus, we add the central bank purchases program for monetary policy reasons, the multiplier would further increase from 1.1 to 1.4 in both regions. And here, the reason being, as said before, that relative to the case, to the scenario where there is no purchasing program, the long-term interest rate will be kept because of the central bank intervention at a relatively low level, and this would further stimulate aggregate demand for aggregate private demand for consumption and investment. Now, if instead we consider the case of a temporary increase in the home spread that is equal to around 50 basis points and lasts for 4 quarters, and we add this spread increase on top of the simultaneous cross-country fiscal stimulus, then you see the home multiplier would decrease from 1.1 to 0.8. And at the same time, the foreign multiplier would decrease from 1.1 to 1. Again, here the story is the fact that aggregate demand in correspondence of the given stimulus would improve to a lower extent because of the higher increase in interest rates associated with this sovereign risk channel and the spread increase. Note that there is a decrease not only in the home multiplier, but also in the foreign multiplier because of trade spillovers that now are lower and associated with the lower improvement in aggregate demand. So there is a lower amount of foreign export to the home country. And finally, as said, if we include in the model a supranational fiscal authority that is able to implement the two this home fiscal and foreign fiscal stimulus, and to finance it with a safe bond that would not imply an increase in home spreads, then we are able in the model to replicate, to get again the same multipliers equal to 1.1 that we have in the case of simultaneous fiscal stimuli without home spread increase. So we are able to replicate with this new institutional feature the same equilibrium and avoid this issue of the financial tensions. Let me show you just the chart, corresponding charts of this table. I will report the responses of GDP under the different scenarios. On the horizontal axis, we have the quarters, and on the vertical axis, the percent deviation of home GDP from the city-state baseline level in percent deviation. I report only home GDP because given our assumption of symmetry, the responses in the case of foreign GDP are similar, if not completely equal. Let me say also before I go ahead that, of course, in correspondence of an improvement in economic activity, there is also an improvement in inflation, labor, hours worked, and so on and so forth. They are all is documented in the working paper. So this is the recession. You see the huge drop associated with the COVID shock. The blue line instead represents the response of GDP when on top of the recession we have also a home-based stimulus. The black line represents the GDP response when the stimulus is monetary union wide. So you can see here the further, by comparing the black and the blue line, the further improvement in GDP, and their difference is mainly associated with the positive trade spillovers I told you before. If on top of that, we also consider the blue dashed line, the role of the bond purchases by the central bank for monetary policy purposes, we have that the GDP decrease is the GDP decrease is even lower. So the difference between the blue dashed line and the black line is really the impact, the role of the low interest, long-term interest rate. If instead we have a home spread increase in correspondence of a euro area wide fiscal stimulus, red line represented by the red line with triangles, you see there is a deterioration in the home GDP response with respect to the case of euro area wide fiscal stimulus without the home spread increase. As I told you here, the story is the crowding out of private demand due to higher interest rate. And finally, the green line, when we introduce in the model this supranational fiscal authority, we are able to replicate the response of GDP to when there is a monetary union-wide fiscal stimulus without financial tensions. I conclude. So country-specific fiscal responses to union-wide recessionary shock mitigate not only the effect on the domestic economy, but also those on the rest of the monetary union. So it's important in a monetary union to take into account the huge trade integration among member states, to evaluate how fiscal responses, fiscal packages should be designed, and spillover, call for cross-country simultaneous fiscal spillovers. And moreover, also monetary policy can contribute to counteract the recession via non-standard measures, that are needed for monetary policy purposes, because the COVID-19 shock has disinflationary impulses, and because the policy rate is at the effective lower bound. I said the combination of COVID-19 shock and secular stagnation forces keep the natural rate of interest to very low interest rate, to very low level, and this implies also low levels for the policy rate. And to conclude, the simultaneous expansion of fiscal and monetary policies are key in a monetary union hit by a COVID-19 type recessionary shock when the effective lower bound holds. No standard monetary policy. And thank you.
It seems to me important the first of the three conclusions. I mean, the idea that the domestic policies could be influencing the expansion, not the GDP growth, not only at the national level, at domestic level, but also at the European level. This is quite important because the discussion, it seems to me, not taking account of this effect. So this is an important point. Also, the fiscal multiplier, as we have calculated, play a role, an important role in this conclusion, I think. But maybe that I'm wrong because I don't have the specific data that you presented, but it seems to me important, this kind of conclusion. Thanks a lot. And then later on, we open the discussion for some point raised by the participant. Now I go ahead with Luca Rossi, Bank of Italy. Luca Rossi presents a paper on revisiting the case for a fiscal union, the federal fiscal channel of downside risk sharing in the United States. Luca, go ahead. Luca, are you hearing me?
Luca, hai l'audio disattivato, penso.
Luca? Luca, are you hearing me? Okay, let me change, and Luca will be the following speaker. I ask you to Giovanni Perstanti to go ahead. Giovanni, there's some problem about the.
Can you hear me?
Yes, yes. Go ahead.
Okay.
Go ahead.
Okay.
You have 15 minutes, Giovanni.
Okay. So, can you see the slide? Yeah.
Yes.
Okay. So, to start off, let's mention the following statement by Stiglitz, which describe the paper core at best, or let me say the paper soul. Focusing on the ratio of debt to GDP is simply economic nonsense. No one would judge a firm by looking at its debt alone. Anyone claiming economic expertise would want to look at the balance sheet, assets, as well as liabilities. Now, to be more focused, let's state the two main targets of this investigation. Show that indicator tests of fiscal solvency implied by debt to GDP ratio are seriously flawed and the source of wrong policy measures with harmful consequences on economic activity and financial stability. Reassess a country debt position using a model-based and consistently measured sustainability indicator. As plain to see, late debate about fiscal consolidation and growth brought to the fore the vital need of rigorous and reliable indicators of government budget position to sidestep the risk of wrong policy action leading to dire outcomes. The reason is simple, because if the indicator fails to detect an unsustainable policy, the government may default on them, rising financial stability. On the other hand, if the indicator gives the wrong signal of an unsustainable policy, the government may be forced to raise taxes or cut spending, drawing down economic activity. The search for such a well-grounded indicator was the main driver of this paper. Now, state-of-art modeling show that the most generally synthetic indicator used in the literature to gauge public debt sustainability and fiscal discipline builds around the evolution of DGR. There exist, however, many theoretical pitfalls disclosing why DGR is a spurious metric. A logical inconsistency emerges when measuring a stock relative to a flow variable, raising non-trivial problem of interpretation. There exists little relationship between GDP and the resource needed to finance outstanding debt, prompting many to search for alternative scale variables such as revenues, GNM, or exports, which, however, are affected by the same fallacy as DGR. It is tied up only to the liability side, missing the asset side and wealth structure that late research found basic to assess economic sustainability, leaves out the intrinsic dynamic nature of fiscal policy, which require an intertemporal framework to be properly assessed. To show up the theoretical and empirical relevance of this issue, we used an endogenous goal setup to show that forward-looking agent of pricing behavior typically give rise to a well-based and not to an out-of-base sustainability index of government policy. We then calibrate the new index for a large sample of European countries, along with US and Japan as reference countries, to show that results are radically different from commonly believed. As to the first point, let's speed up model presentation and discussion, as it is quite standard and with the usual meaning for the variable, as you can see from equation 1 to 5. Solving this model along the balanced growth path and letting for simplicity government bond consists only of perpetuities paying a coupon on 1 unit, it is to show that the government budget constraint can be expressed as a function of total wealth and wealth structure. Total wealth is WT and wealth structure is omega, given by the ratio of capital stock on total wealth, as shown in equation 12. Integrating this equation gives the intertemporal budget constraint of the government, which, when solved under the decided condition of a positive interest growth gap and divided through by the size of the current wealth, leads to equation 14, which is our sustainability index of fiscal policy. A similar approach can be found in a lot of late papers focusing on economic sustainability as indicated in this slide. Now, a lot of notable gains follows from equation 14. First, you see all the variables are consistently measured relative to the current size of wealth, thus overcoming the shortcoming of DGR, which measures stocks relative to flow variables. The right-hand side includes two consistently normalized components. The first is the current level of debt. The second is the present value of primary balance, government balance, so that the left-hand side measures the fiscal adjustment required to warrant the long-run sustainability of government fiscal position as reflected by the two components on the right-hand side. Provide a dynamic score of the government debt, by including the intertemporal nature of fiscal policy and its impact on the growth rate and the other macroeconomic variable, does not include any threshold level for the debt, which is puzzling and highly questioned in the economic literature. Provide a simple, transparent, and standardized measure to be applied to all countries, shift emphasis from level to paths, and compute the adjustment required to converge to stability path, implies that the adjustment need not occur immediately, but better span over a longer horizon to avoid recession from fiscal contraction and the risk of devilish dynamics driven by self-fulfilling expectation of government debt. It is consistent with and strictly reflect via the present value of primary budget, the government budgetary policy and the interest rate growth gap, a feature simply not found or quite absent in DGR index, takes into account the role of the capital stock by multiplying primary balance by the ratio of capital stock to wealth, makes clear where the original scene of the DGR takes root, a sustainability analysis not addressed within an intertemporal framework linking fiscal policy to the rest of the economy. Well, based on equation 14, we now can assess a country's fiscal position as follows. When FT is lesser or equal to 0, we say that fiscal policy is strongly sustainable, meaning that the government is running enough primary surpluses to pay off all its current debt. When FT is greater than 0 and lesser than the debt wealth ratio, we say that fiscal policy is weakly sustainable, meaning that the government is running as primary surpluses, but not enough to pay off all its debt. When FT is greater than the debt wealth ratio, we say that the government policy is unsustainable, meaning that the government is running fiscal deficit, which adds to the current level of debt, requiring an adjustment to ensure the viability, the long-run viability of the fiscal position. So let's now turn to empirical investigation. Okay. So, consistent with the equation 14, here, consistent with equation 14, is written as 14 prime for convenience, where VBT now denotes the present value of primary balances. We computed the index only for countries with a positive interest growth cap, calibrating the set of parameters needed to compute our index from available data and from equation 19, which highlights another notable property of our index, that is to say that the computation of FT now requires only realized value for the variable of interest, thus escaping the impossible mission of trying to predict future primary balances over an infinite or very long horizon found in many empirical approach to debt sustainability, DGR based. The results, the main results, are shown in tables 3 and 4 and in figure 1.3. Table 3, in table 3 show the value of our index and its two main components, along with the DGR, the standard DGR based index. Table 4 show the country sustainability ranking. Now, from this table, we see that the fiscal position of Sweden, Denmark, Finland, Netherlands, and Belgium are strongly sustainable since the index is less than 0. The position of Italy, Germany, and Portugal are weakly sustainable, whereas all the other countries have an unsustainable position. These results contrast sharply with the DGR-based assessment, where the ranking of countries such as Italy, Belgium, Austria, France, United Kingdom, United States, and Spain are fully overturned. Additional information are also provided in figure 1.3, which show that which confirms the results of table 3 and 4, shown a dynamic of the index not too far from the average value, notwithstanding a common upward trend in the crisis period, just offset by a downward trend in the post-crisis phases. These results are open at variance with consolidated beliefs about sovereignty and sustainability in EU countries, and signals that indicators and tests of budget solvency based on the dynamics of DGR and widely used in the current literature are strongly biased and misleading. This implication follows immediately, as you can see, from equation 40 and table 3 and 4, which show that our index strictly reflects via the present value of primary budget, the common budgetary policy, and the interest growth gap, a feature not included or not found in the DGR metrics. Also, the table 3, reveals that when consistently measured relative to the current size of wealth, public debt sound much less threatening than guessed by DGR, since now public debt are on average only 18% of total wealth, that is less than 1/5 of total wealth, in contrast to near 90% of GDP. This obviously is simply the result of the different scale factor we use, but no doubt the picture is now less gloomy and compelling than commonly inferred from DGR metrics. Also, the figure reveals a clear tendency towards strong sustainability in most countries, signaling that debt fears constantly rise in policy, academic, and mass media debates after the great financial crisis are frankly overdone. These results are clearly at variance with consolidated beliefs about sovereign debt sustainability in EU countries, and signals that the indicator and test of budget solvency based on the dynamics of DGR and widely used in the current literature are strongly biased and misleading. The new approach to fiscal sustainability and public debt assessment is not without policy implication. However, as it points to policy reaction and commitments opposite to those recommended for many EU countries because of DGR, we therefore expect that the new approach could act as a powerful therapy against the dangerous debt obsession and the single-minded focus on government liabilities found in the literature and international policy institutions. A less debt-obsessed, but more growth-oriented policy strategy is really what strongly needed. The case of Belgium, Italy, Austria, and France, wrongly rated on the opposite side of sustainability, is highlighting and signaling that DGR-based data are biased and misleading, and a fundamental factor behind the policy-induced uncertainty and adverse impact on economic activity and growth observed in many European countries after the great financial crisis. To conclude, let's stress that the main implication to emerge from our investigation is that the DGR-based index is inconsistent with the basic of both measurement theory and economics, and a fundamental source of ruinous and perverse policy action. These are key issues that strongly rise the need of a reliable measure of fiscal sustainability. As we have shown, indeed, the search for a well-grounded sustainability indicator leads to a debt-wealth ratio, not to a debt-output ratio. Furthermore, when applied to a large sample of EU countries, the results appear to be very different from consolidated beliefs and signal that the indicator's test of fiscal sustainability based on DGR are strongly biased and artful. So, to get out of such short water, we advance the following two critical policy measures. Heavily taxing DGR users and finance DWR users, add to the DGR the asset to DGP ratio, clearly another faulty measure, so allowing everyone to gain by their ratio the right debt to asset or debt to wealth indicator and avoiding to be caught in spurious metrics, false statement, and scientific mess. Thank you so much for your listening.
It seems to me that this is a new step of the battle of Giovanni Persanti for more, more policy-oriented toward the growth, and no link to the idea of the control of the deficit and debt. Okay, it seems to me that the argument, Giovanni, if you want to be discussed later on, and then now we have to give the floor to Luca Rossi that before can speak.
Mi sentite adesso? Ottimo.
Yes, now I'm listening to you.
Okay, sorry for the inconvenience.
Right. Luca Rossi presented the paper on the case for the fiscal union, the federal fiscal channel of downside sharing in the United States, downside risk sharing in the United States. Okay.
Okay, so good afternoon, everyone, and thank you for having me here. So yeah, today I'm going to present this research that I've been working on for a while, but of course it's a work in progress, so any comment is very much welcome. Of course, usual disclaimers apply. So the debate on European integration was already alive before COVID, of course, with the 5 presidents report in 2015. The whole debate has started to gain track again, and yeah, with COVID-19 and the Next Generation EU, both academia and policymakers started to talk more about various aspects of European integration. So the merits of a potential fiscal union in Europe are mainly based on past research on US data. And this research basically said, basically found that in the US, the federal government really does little to ensure states' income. Whereas private markets actually provide much more risk sharing. So the policy advice for Europe was basically, just push for deeper capital markets integration and forget about fiscal integration. You just don't need that. So this paper kind of challenges this view. So the contribution is threefold. So first, the first contribution is a methodological one. So we are the first. This is the first paper which focuses on downside risk sharing. And because I believe this is like the sort of risk governments really want to hedge people against. So what we do is we draw from finance literature, and we propose a very simple method to use downside risk concept as opposed to standard risk ones. And then we provide new estimates of fiscal risk sharing in the US, and we show that contrary to past findings, the federal government does accomplish quite a lot in ensuring state income, idiosyncratic state income growth. And then finally, I don't know if I'll have time to go through this, but we also challenged some classic result, which found that the capital market channel of risk sharing actually did help a lot. We challenge these and find that those estimates are likely to be severely overestimated. Okay, so when we talk about risk sharing, it's important to know what we're talking about, because sometimes there is some confusion about the terms. So here we take the definition from Malkin and Winson. This is a Fed paper. So basically, they say, irrespective of whether the state is a high income state or a low income state, risk sharing rule implies that if that state is hit by a temporary idiosyncratic shock, that state will receive short-term relief through transfer payments and lower tax payments to the federal government. This, of course, is a different concept than redistribution, whereby here we really have richer states transferring resources to poorer states over time. Now, the whole literature started in 1992 with this paper by Salim, Martin, and Sachs. Of course, the academic interest started together with around the Maastricht Treaty, I would say. So in this paper, the authors perform simple regressions of taxes or transfers on disposable personal income. So they try to single out very simple elasticities, and they find that the federal government accomplishes between 30 and 50% stabilization of state idiosyncratic growth. Then later on, von Hagen in 1992 say, look, you are using levels and not growth rates of GDP. So that's so what you're really estimating is redistribution, not stabilization. So I show you that if you use growth rates, we actually find not that much of risk sharing. So von Hagen finds something like 10% risk sharing. Then later on, Bayum and Manson in 1995 try to separate redistribution from stabilization using personal income, and they find a 30% stabilization capability of the federal government. And then there is this 1996 paper by Asdrubal and co-authors. This is really the landmark contribution. It's a QJE, and it's still very much cited by policymakers. Their results are still very much cited. This is the authors really provide a very smart framework where they allow joint estimation of three channels of risk sharing. So the capital market channel, the credit market channel, and the fiscal channel, all within a simple GDP variance decomposition. And again, those authors find that the capital market channel really is the one channel that hedges the most of idiosyncratic risk. Later literature, I think I don't have time to go through the whole thing, but many authors basically replicated Asdrubal with a new data set, or adding controls, or adding some dynamics, because the papers in Asdrubal is static, but they pretty much found the same results. So here what we do is we don't use neither personal income nor GDP. We go with labor income, as done in Duwicke and Farvak in 2018. And the reason is we are interested in the average US citizen, not the average US state. And US states, they have pretty much wildly different populations. So if you take California in 2018, it had a population that was larger than the 22 smallest US states. The thing is, since we have to actually work with state level data, because we don't have household level data, if we focus on labor income, we argue that we sort of reduce a lot of aggregation bias. And the reason is mainly that capital income is extremely concentrated. Okay, so basically those are numbers from the CBO in 2017. Those are numbers pretty much we all pretty much know, but we see that capital income is very concentrated at the top of the distribution. So if we were to use personal income or GDP, we would be including capital income in our equations, and actually we would be trying to estimate risk sharing over flows of incomes that actually accrue to a little fraction of the population that earns the great majority of their income on capital. So that's the main reason why we go labor income. So the whole idea of the federal channel of risk sharing is, so we basically start out with wages and salaries. So that's our definition of income before federal government intervention. And then the thing is, when a state is hit by idiosyncratic recession, let's say, as compared to national growth, what happens is that state starts to pay lower federal taxes just because GDP decreased, and starts to receive more federal transfers in terms of, let's say, food stamps or unemployment insurance. So those flows, federal taxes and federal transfers, when you add them up, if you add them up, you basically obtain a new definition of income, of labor income, which is like wages after the federal government intervention. So basically, what happens is, if we take, let's say, citizen from Louisiana in 2005, the Hurricane Katrina hit. Let's say, let's take, I don't know, a farmer. You have a huge idiosyncratic loss in income. So basically, you start paying very much less federal taxes, and the government starts paying you federal transfers. So your income actually decreases way less than what would have done in absence of those interventions. So this is the basic idea, and it is not new. I mean, this is just to make things clear about how this channel works. So there is one paper that, I mean, it's it has been published well. It's a review of economics and statistics, but I believe it didn't receive much attention as it should have deserved. So this is Athanasoulis and Van Winkop, 2000. So this is the only paper where the authors explicitly treats risk with an ex-ante concept. So instead of estimating elasticities on observed covariances, which is what has been done in the whole literature, here the authors really take a stance on risk, which is probably, I would say, the correct one, which is the variation in the unexpected component of the variable you're interested in. Indeed, actually, what other papers have done is probably more measuring the degree of income smoothing rather than risk sharing. And if you think about, so let me explain in a nutshell what they do. So basically, here you see on the left-hand side growth rate of state I at time t. Between time t plus h and t. And on the right-hand side, you have a bunch of controls. So basically here, the authors are trying to predict idiosyncratic growth with some standard growth, with standard controls taken from the growth literature. And what you end up with here is this residual. This is idiosyncratic, and diversifiable residual, whose standard deviation is a measure of diversifiable risk. And if you think about this framework, so it's the standard deviation of this residual is their measure of risk. And if you think about this, is really consistent with the more recent uncertainty literature. If you take the paper by Jurado and co-authors in 2015, the AER measuring uncertainty, that's exactly how they define uncertainty. So they say a lot of uncertainty measures out there are basically based on a concept of volatility, but volatility is not necessarily risk. So when we think about risk, it really must be the variation around the unpredictable component of the variable you're interested in. So here, the authors do the very same thing 15 years earlier. So this is one more interesting thing about that. So and they say, okay, look, what we do is we estimate this equation here by using a definition of income before federal government intervention. We estimate the standard deviation, and then we do the same with income after federal government intervention. So we basically end up with two measures of risk. A stands for after and B for before federal government intervention. And the idea is really simple. So they say, okay, if idiosyncratic income growth has become more predictable after federal government intervention, then some risk sharing must have been going on there. And the way we measure that is basically simply the percent reduction in standard deviations between the two standard deviations. So that's what they do. So we basically borrow from them, but we recognize that the actual concept of risk we are interested in is, so the federal government is all interested in hedging downside risks, so negative deviations from what we would have expected state income growth would have been. Okay, so this has been recognized long ago by Markowitz in 1959 in a very different framework, so in a finance framework. So he said the very same thing. So he said basically, you know, investors are worried about negative returns. So if you have a stock that has, let's say, small negative returns and a series of very extremely large positive ones, if we are to compute risk with variance, you end up with a measure of risk that is not exactly what you would want to have, because it would be inflated by the positive returns. So he basically said, okay, let's just trim down the distribution of returns and focus only on negative ones and just compute the variance on that. So I call that semi-variance, and that's my measure of downside risk. So that's what Markowitz did. So what we do in our framework is exactly the same thing, but instead of having financial returns, we have forecast errors. Okay, so what we do is we take our series of forecast errors and we just cut all the positive, all the unexpected positive idiosyncratic income growth. And we do the same thing. So we compute a residual standard deviation on those conditional errors. And our measure of risk sharing is very much the same as the one in Atanasoulis and Van Winkle, but we use this measure of downside risk instead of the standard residual standard deviation. So that's what we do. Then, okay, I think I don't have time to go through this, but so in the paper I show that actually I also have to make a further adjustment. I'm sorry, I really don't have time to go through this, but I mean, if you're interested, I can send you the paper. Basically, we have to add a further adjustment in the formula of Atanasoulis and Van Winkle. This is actually something one should also do in their framework. So this is a sort of improvement over their formulas, I would say. Then, of course, what we end up with is an object that doesn't have a pretty much known distribution. So we just bootstrap estimates with the non-parametric bootstrapping Capitanius. Okay, so those are our baseline estimates. So what you see is, so on the x-axis, you have horizons. So we use business cycle frequency. So we go from 1 to 8 to up to 8 years. And then on the y-axis, you have the amount of idiosyncratic income growth that is hedged by the federal government. So you see that starting from year 1, estimates are not that high and actually very much in line with past literature. But then starting from Horizon 2 onwards, the estimates go up. Probably, I guess, government programs take time to have an effect. And you basically see that, so on average, over our 8-year horizon, the federal government accomplishes a 30% income stabilization. So that's what we find. So then we also ask ourselves, okay, so let's see whether those results are driven by poorer states enjoying more of risk sharing and richer states not enjoying risk sharing at all. So that's what one actually could reasonably expect to find. And instead, so why will we find that poorer states, so the way we rank poor and rich state is we take cumulated real GDP between 1998 until 2018. So that's our sample, and we rank states based on this GDP per capita, of course. So we see that poorer states indeed enjoy more risk sharing. So that's the blue line. But richer states have an amount enjoy an amount of risk sharing which is very much in line with our baseline. So that we found that to be sort of surprising and interesting. Let me skip the sensitivity because I think really I don't have time to go through that. So here what I show is that if we estimate our model on post 2018 data, so basically 10 years worth of data, we see that our measure of downside risk sharing, as opposed to standard measure of risk sharing, kind of gets kind of tell a sort of different story. So while in terms of expectation, you see that estimates are not that much different, although they are in horizon 5, 6, and 7. So here we have something like 5-6 percentage point of difference. The interesting thing is the upper band. So those are 95% bands. And what we see is that if you use our downside risk sharing metric, you see that the probability that the baseline estimate is actually underestimating the amount of risk sharing is much higher if you use our methodology rather than a standard risk sharing. And you see that by these, by looking at this very large, much larger upper band. Whereas you see that in the lower band that doesn't occur. Okay, I think I'm running over time. I guess I have to conclude. I mean, how much time I have? So, can you hear me?
Now the time is to conclude, obviously.
Okay, yeah, let me conclude. Okay, so I don't have time to go through the second part of the paper, but basically, so what I showed in the second part, as I said, is that what was believed to be the main risk sharing channel, which is the capital market channel, those results are probably driven by I would say a problem in the data. But yeah, I mean, if you're interested in that, I can send you with the paper. So to sum up, yeah, in this paper, I revisit the case for a fiscal union by showing that its beneficial effects are higher than previously calculated. So while past research found that the fiscal channel could absorb only 10% of income fluctuations, I find that number to be around 30%. And then, as I said, there is this further results about the capital market channel. So with this, I'm done. Thank you.
Thanks, Luca. It seems to me that in our conclusion, you don't put in evidence the main point that you presented at the beginning of your speech. So that dipping capital market and risk sharing is better than trying to enlarge fiscal policy in some extent, if I well understood.
So I'm not sure I understood the question. So what I find is that the capital market channel has been, the capability of the capital market channel has been sort of overestimated. So with this, I'm not saying that we shouldn't go for a deeper capital market integration. So risk sharing is just a part of what a capital markets union can achieve. So all those results, I'm not definitely saying that we shouldn't go for deeper capital markets integration. I'm just saying, yeah, that in terms of risk sharing, the results are probably have been overestimated.
Thank you. Now you have the paper of Martino Tasso and Giuseppe Ferrero and Massimiliano Pisani, Bank of Italy, on policy mix during a pandemic crisis. So go ahead.
Yes,
the speaker is Martino Tasso, I suppose.
Yes, thank you. Can you hear me? And can you see the screen?
Yes.
Yep.
Okay, great, thanks. First of all, let me thank you, the organizer, for having us. It's a pleasure to present our work at this conference. The paper is joint work with Massimiliano Pisani, who spoke just earlier, and Giuseppe Ferrero. We are all working at the research department of Banca d'Italia, so the usual disclaimers apply. The paper is about the macroeconomic impact of COVID-19. And in the paper, we review the macroeconomic literature on the effect of the shock, the main policy measures which were taken by fiscal and monetary authorities across advanced economies, and the likely legacy for the medium term, for the future. So, of course, the macroeconomic literature on COVID-19 is a vast one, so it would be difficult to give a full recollection of all the literature. Let me just highlight some key features which are important in our mind to explain the role of the policy mix in the current juncture. While COVID-19 is for sure a global shock, it has very heterogeneous impacts. These heterogeneous impacts are across economic sectors and across different workers. We all know that the first sectors to be hit by the shock were the contact-intensive service ones. But then the shock was spread to the rest of the economy through cross-sectoral interlinkages, or because of the reduction in the wages of the incomes of the affected workers. And even job losses were not evenly distributed across workers in the economy. Moreover, what we think is important is the fact that while the shock is hopefully temporary, there are some chances of long-term, let's say, negative impact on the productive capacity of the economy. And these scaring effects could be due to long-term unemployment or underemployment spells, the disruption of the education sector, and possible reduction in investment by firms who may fear lower opportunities in the future because of the high uncertainty we live in. Another important element of the COVID shock is that it came in an environment in which many advanced economies were already living in an environment of historically low nominal and real interest rate, low inflation, and low growth in many economies. Low rates are a consequence of structural forces, so to some extent they are likely to be persistent even after the end of the shock. But this factor is important for the division of labor in terms of macroeconomic stabilization in the current circumstances. In normal economic circumstances, the roles played by monetary and fiscal authorities and monetary and fiscal policies are clearly distinct. In the current circumstances, though, this distinction is not so clear-cut, and this is because it's likely the case that a larger fraction of the households are now constrained, so Ricardian equivalence may not be so relevant in this moment. And it's also important to recall that monetary policy is constrained at the effective lower bound in many countries. So monetary authorities have to resort to unconventional measures of monetary policies. So during the COVID shock, monetary policy could not be the only game in town, as it's been the case in the past in some countries. And I'm referring, for example, to the case of the aftermath of the sovereign debt countries, sovereign debt crisis, sorry, in Europe. So it would be difficult to give a fuller account of all the measures which were implemented by monetary and fiscal authorities, but I would like to point out some common main theme. In terms of monetary policy, where it was possible, the monetary authorities cut official policy rates. Where this was not possible, they resorted to unconventional policies like forward guidance or purchases of assets. But on top of that, some very heterogeneous measures were implemented to provide liquidity to commercial banks. For example, that was the case of the Peltro program by the European Central Bank. Fiscal policy worked through 3 channels. We know from estimate by the IMF that in 2020, the real GDP across advanced economies dropped by about 5%. This by itself induces a reduction in revenues, and it induces an increase in expenditure for, let's say, unemployment expenditures, for example. On top of that, the fiscal stance was expansionary, and it was expansionary by 6 percentage points of GDP, according to the IMF. Other measures do not show up in the standard measurement of fiscal stance, but they do favor liquidity for both household and firms. And I'm referring, for example, to measures like tax deferrals, equity injections, and most of all, government guarantees. Again, even for in the case of fiscal measures, measures were really heterogeneous, but all in all, I would say that measures have been mostly timely, mostly temporary, and mostly targeted. If I had to pick a couple of examples of measures which were implemented in many countries, I would probably quote the wage supplementation schemes and targeted liquidity support in the form of government guarantees, which have been widely used. In the case of guarantees, that was especially so in both the European Union and in the UK. Let me give you, let me spend just a minute on the euro area, because the euro area, being a currency area without a central fiscal capacity, was particularly put to the test by the crisis. The shock induced very relevant changes in this respect. On one hand, country-specific responses were possible thanks to the general escape clause of the SGP. On the other hand, some very important common policies were thought and enacted during the crisis. And for sure, the most important one is the Next Generation EU program. And we learned from Massimiliano's speech at the beginning of this session that the coordination of national fiscal stances is particularly relevant in Europe because of trade interlinkages. Because of the recession and the risk of deflation in 2020, the incentives of monetary policy and fiscal policies, which are run by independent authorities with independent mandates, were clearly aligned in 2020, and is still so in 2021. But we would like to say that there are also some important complementarities. Let me give you a couple of examples. The liquidity provision by the central banks, which I talked about a minute ago, and the loan guarantees programs by governments clearly complement each other. Another example is the fact that monetary authorities implementing expansionary monetary policies to counteract deflationary risk. But these policies indirectly favored bold targeted fiscal measures through a reduction in borrowing costs for governments. Of course, the higher borrowing from governments coupled with the drop in nominal GDP resulted in an increase in the debt to GDP ratio in 2020 across all advanced economies. According to the IMF, the increase in the debt to GDP in 2020 was worth about 16 percentage points. And as you can see in this graph, the level of debt to GDP is not expected to go back to the previous pre-crisis level anytime soon. What is also important to note is that, as I said before, many governments resorted to government guarantees during the crisis, but government guarantees are mainly a contingent liability for the moment being. Eventually, at least a part of this guarantee will become an explicit liability and will add to the pile of debt. And even before the COVID-19 crisis, the debt ratio were high and expected to rise in the long term because of the aging of the population in many countries. Of course, high debt are a risk for countries, and this is because high debt usually is associated with higher uncertainty, about future policies, for example, and higher borrowing costs for the private sector. High debt increases, let's say, reduces fiscal space to counteract future possible crises. And of course, it increases the exposure of countries to volatility in market sentiment when you have to refinance a large part of your debt every year. So, of course, high debt are a risk, but in this particular moment, there are some risk mitigating factors I would like to point out. First of all, we live in a world of low and downward trending low implicit interest rate on debt. This is something that has been going on at least since the 90s, and it is expected to continue in the medium run. This implicit interest rate on debt, as I said, they are low, and in many cases are even lower than the GDP growth rate. And this condition by itself helps containing the growth of debt to GDP ratio. The second thing that I would like to point out is that central banks in the last few years have become more and more key players in the market for government securities. And this is was especially true in 2020 when central banks across advanced economies purchased an amount of government securities which was comparable to the amount which was issued in the same year. At the end of 2020, according to the OECD, the central bank held about 45% of government securities in Japan and Sweden, and about 20% in the European Union and the US. In this chart, we plotted the case of Italy. This is the share of government debt held by the Bank of Italy. As you can see, the share was historically around 5%, but that did increase with the beginning of QE, and this is what happened in 2020. Of course, the downside of this is that central banks across advanced economies have now very large balance sheets. And on one end, large balance sheets increase the risk of losses for central banks. On the other hand, some commentators fear that the concern of damaging debt sustainability could interfere with the proper conduct of monetary policy when the central bank is holding a large share of government debt. We have to keep in mind, though, that if the exit, to the extent that the exit from accommodative monetary policy signals improved macroeconomic perspectives, this risk for the debt dynamics are attenuated. In the medium and long term, of course, many of the risks we discussed about would be much lower with the higher growth. In the near term, the strength and the timing of the recovery is still very uncertain. So there is some consensus in policy circles about the fact that support measures should be removed with caution. But of course, we cannot forget about the problem of high debt. So once the recovery is fully underway, countries with little fiscal space should gradually achieve primary surpluses. Two things are particularly important, we think. First, because of international trade spillovers, in these circumstances, international coordination is important. Second, the quality of public finance measures will play a role. For example, we think that this is the case for public investment. Public investment have expansionary short-term effect like many other forms of expenditure, but they could also have a positive impact on potential growth. Of course, a careful selection of the project and a careful execution of the projects are key. But provided this is the case, in the current circumstances, the investment multiplier is likely to be relatively higher than in normal times. And this is because we are living in an effectively lower bound environment in which the central bank is not going to react. It's likely not to react to an investment program. And we are also living in a world of high uncertainty, which by itself discourages private initiatives. So let me conclude because the time is running up. In the paper, we review the literature on the responses to the COVID-19 shock in advanced economies and the likely legacy of this shock for the future. The COVID-19 is a global shock for sure, but it's a peculiar shock with very heterogeneous effect, and it came in an environment of low rate, which is very important for the policy mix. The joint effort of monetary and fiscal policy was crucial and is still crucial for the cushioning of the blow of the crisis. In the near term, because of uncertainty about the strength of the recovery, the withdrawal policy support should be cautious. Once the recovery is fully underway, though, governments with limited fiscal space should gradually reach primary surpluses to rebuild buffer in light of future possible shocks. And in this process, the quality of public finance measures will be crucial to raise potential growth, and public investment could play an important role in this respect. Thank you.
Thank you very much. I think that the quality and selection of investment is important, but I have some doubt about the fact that the multiplier would be better just because the private investment are influenced by uncertainty. But anyway, seems to me two different aspects that not connect each other. Okay, but let me say that we are a bit late because we have to close the section, but let me check the hour. We have 10 minutes for discussion. Is there anybody that want to raise a question? Please go ahead.
May I ask one?
Please go ahead.
Thanks. Yeah, so one question to Martino. So I was wondering, so how much do we know about the size of contingent liabilities? I mean, like, guarantees guarantees that governments provided during the crisis. How much is, I mean, I guess the uncertainty around that is, I mean, around their realization is pretty huge, I guess. I mean, at least the distribution, it's probably sort of very, I mean, highly non-normal. And whether markets, and to what extent markets are pricing this risk. So the risk of realization of those contingent liabilities. That's one thing. I mean, that's something I don't know if you can tell me something about that. Thank you.
Can I answer now? Okay, I will just answer it. So it would be difficult to give you a single reply for all. Can you hear me?
Yes.
Can you hear me? Okay. So it would be difficult to give you just one number. The situation of contingent liability is very heterogeneous across countries. And as I said during the presentation, the use of government guarantees was especially large in some European countries and in the UK, but was less important, for example, in the US. Of course, there is a distinction between the total amount of the envelope of guarantees which was extended, which in many cases was sizable, many points of GDP, and the actual use of these government guarantees, which in many cases is much lower than the total envelope. Then you have to understand that not all of these government guarantees will actually be called. So it would be difficult. I mean, and if that is the case, the call of these guarantees will happen gradually over time. Is not going to happen all at the same time. So this is a risk, of course, but we should not, let's say, overemphasize this risk, because it will have an effect, a gradual effect on public accounts. Not, it's not going to show up immediately.
Okay, thanks.
So one
Yes,
to
of course.
one to Luca and one to Professor Piersanti. So to Luca, whether you are able to see what happens to your risk sharing measure during the global financial crisis, because clearly that's a common shock which is, I guess, impossible to share for households with anyone. So I would imagine there would be a drop of that during the financial crisis. And the other and a related question, because I think to risk sharing in terms of consumption risk sharing. Well, you and the rest of the literature focuses on income risk sharing, but if I think to theoretical model, it's consumption that really matter for utilities. So I was wondering whether there is some possibility to have data on and to estimate consumption risk sharing. Then to Professor Piersanti, again, two quick questions. One, whether you think that the degree of liquidity or wealth could somewhat matters for the concept of that sustainability, so to have a wealth that is more or less liquid. And the second is whether in your model you consider, because as far as I have well understood, you solve the model forward and then you apply the transversality condition. I was wondering whether the initial wealth condition do matter for your work, and to what extent. Yes, thank you.
Okay, I think I start answering. So okay, so in a way you're right. So both the 2008 financial crisis and of course even more this one are common shocks. So risk sharing is about ensuring idiosyncratic risk. So indeed, what I find is that when I estimate the model for 2018, so these 10 years of data, I mean, of course, it's not a perfect isolation because it's, but I mean that I guess was the best I could do. I actually find that the amount of risk sharing is not very different than my baseline estimate. What I did find it was different is what I showed you. So if I use my downside risk sharing measure as opposed to the standard risk sharing one, then yes, I do find that the distribution is, I would say, much skewed on the upside, meaning on probability of risk sharing being underestimated if you use standard measures. But in a way, you're right. So on the other hand, this is something I still didn't. So I still didn't look at COVID, so 2020 data. I still cannot run the model for 2020 because I use in my data setting I use some data that is available only up until 2018, some census data. But I guess so in terms of the COVID shock, yeah, of course it's symmetric. Then I also probably would expect that some states would have fared better and worse anyways, I guess. But that's just a speculation. I mean, I still didn't look at the distribution, but of course, yeah, it would be very interesting to look at that. And then you're right. So for the consumption risk sharing comment, you're right. So basically here, what I do with in my framework is let me go to what Asdrubal and co-authors do. So they basically draw from the consumption risk sharing literature. So you're right. What they do is they test for full risk sharing, and then for full risk sharing in terms of consumption. So in their model, if there is full risk sharing, then there is perfect consumption smoothing. But then what they do is they disentangle the three channels. So you basically start out with GDP growth and you end up with consumption growth. So if consumption growth is let's say orthogonal to GDP growth, then you have perfect consumption smoothing. But then what they do is they are able to separate every channel. What I do in my framework is I basically focus on a little part. So that's the fiscal channel. But you can think about that as a portion of income that is mooted and that eventually will go into consumption smoothing. I mean, I don't know if I I explained myself well, but I mean, we can talk about that later maybe. Thanks.
Okay. Two very short reply, since there is another session where I need to be a chair. So let me say, you asked the question of liquidity. Okay, first question. The second was, I don't remember. I cannot hear you. You have.
Sorry. So the second question was about initial wealth conditions, if they matter.
Yeah, yes.
It's a clarification question. Yeah.
Yes, yeah. The second question is simple to understand, because you see, current debt is measured relative to the current level of wealth. So it's the current values of debt and wealth that matters. As to liquidity, we think of wealth as simply collateral. So it's not so relevant if there are more or less liquid assets in the wealth. Surely, if you need to sell, this may become important. But what matters is the ratio of capital on total wealth that the most late papers have taken as basic to value economic sustainability, because this means that because the same wealth does not imply that you have the same potential capacity and the same productive capacity, because what matters is how much capital and hence productive capacity you have with respect to total wealth.
Okay, I see. Yeah, thank you. We cannot hear Professor Paganetto.
More time. Excuse me.
Yeah.
A number of metrics about fiscal or debt sustainability, which we think to be very relevant, because if you use the debt to GDP ratio, you are navigating with the wrong instruments. Sorry?
No, I am just preceding you. Go ahead.
Okay. No, sorry. I finished. If there are any questions, Luigi, I need to chair another the young session. So.
Okay. Thank you. As an interesting session, indeed, in which you discussed about the mix of fiscal and monetary policy in a monetary union as a difficult job to take this problem. And I know that Giovanni is very linked to the idea that the debt indicator is not enough to make the right choice, if I well understood.
Yeah.
Okay.
Yeah, we have discussed many times.
Let me say that there is another problem, because all the discussion of the different paper presented the view linked to the need to manage the policy, monetary and fiscal policy, take into account of the general economic constraint. But there is a problem that is coming. The problem that the European people is asking some different approaches. The European people is asking for public goods. Public goods are one very important point. And if you take into account of this general demand, I mean, from people, that is supposed to start now with the conference on Europe, future Europe. A lot of things could change in the approach on the policy, on the fiscal policy. But let me say that your paper are rightly linked to the actual, environment that we have to face. And thank again for being with us. Thanks again for your paper, and looking for the next step and the next conference in Mondragone, but being present in Mondragone, because Mondragone
Yes, sure.
has some of us now is a very very nice place in which you can use obviously web system, web connection, but there is a possibility of a personal interconnection that is also very important in my personal view. Okay, my best to everybody.
Thank you.
Thank you.
Thank you. Bye.
Thank you. Bye.
Thank you. Bye.
Bye bye.
Nice to greet you.
Nice
Bye.
to meet you. Thank you.
Bye bye.
Okay, thank you. You should be able to see the screen, right?
Yes.
Okay,
yes.
I'm gonna start 10 minutes.
As
So thank you for
and published by Fraccaroli and Pizzigolotto.
Exactly. So thank you for this invitation. My name is Nicola Fraccaroli. I'm from Brown University, where I'm doing my postdoc, and this is a joint work with Alessandro Pizzigolotto from the Norwegian School of Economics on credit shocks and populism.
Let me add only an information. This is a session dedicated to a colleague of ours, Giancarlo Marini, an economist that has been with us and the Faculty of Economics, that was particularly dedicated to young people, to the students, and we want to continue his tradition by means of this session, that is a session each year in the Villa Mondragone program. Okay. Go ahead.
Thank you. So the question that we are addressing in this paper is whether there is a link between credit shocks and the electoral support for populist parties, because we've seen that with the financial crisis there was a growth in the electoral support for populist parties, and many scholars explore the relationship between the two, but they look at different aspects. So I'm not going to go through the literature in detail now, but they look at, just to give you an overview, they look at unemployment and how trade disruptions caused by the crisis fuel populism or austerity or political uncertainty and so on. But what we're wondering is, what about bank credit? And there are two reasons why this is interesting. First of all, because the great financial crisis started in the banking sector, and it was characterized by a sharp and strong decline in bank lending, first of all. And also because credit swings, as we know from the recent literature, can affect political preferences. And we know it from both like recent evidence, but also recent evidence on historical data. So we know that, for example, a credit boom can increase the support toward the incumbent, toward the government, whereas a credit shock can increase political unrest. And there is a very nice paper that is a recent one that analyzes how the credit crisis in 1931 increased the support. It was an important driver for the support for the Nazi Party. But to date, we have no clear evidence on whether drops in bank lending contribute to the rise of populism in modern democracies. And one reason for that is that the main challenge is to disentangle the effect of banking crisis, which would need indeed a suitable natural experiment to examine that. And this is where the contribution of our paper comes in. So we try to address this question, which is, can a credit contraction fuel populism, being based on a specific credit contraction, the one that happened in Germany for the Bank of Commerzbank. And it was a credit contraction that was very sharp, was exogenously driven, so not related to domestic economic conditions. And it was at the very beginning of the great financial crisis. Then we are going to combine the exposure to this exogenous credit shock with data at individual level to see how political preferences of each individual based on the different German counties have changed in relationship with the exposure to the credit shock. And we are going to go a bit further in exploring this relationship by using text analysis on how parties, to measure how parties supply populism, by looking in particular at the degree of populist rhetoric in party speeches in the Bundestag, in the German parliament. And we're gonna look at whether voters that are hit by the shock tend to vote for parties that use a more populist rhetoric rather than parties that discuss more often, more frequently, the topic of the banking crisis and the credit crisis. So just to give you a bit of background about this exogenous credit shock, this is an instrument that was introduced first by Uber in this American Economic Review paper of 2018, in which he explains in detail, so I'm not gonna spend too much time here, he explains in detail how this shock was exogenous. It was a shock that was generated in the International Trading Book of Commerzbank, and that caused a sharp and immediate decline in Commerzbank credit supply compared to the rest of the credit supply in Germany. So of course there was a drop in bank lending all over Germany after 2010 with the Eurozone crisis, but this related to Commerzbank was something that was totally generated from the International Trading Book, so something that was imported and totally unrelated to domestic economic conditions. And this is interesting. The case of Germany is interesting not only because we have this exogenous credit shock that we can exploit, but also because of the characteristics of German populism. Because we know that, like in other countries, populism increased also in Germany, but it was a very multifaceted populism, because we have both parties from the left and the right-wing side, and we have indeed multiple parties, which is not the case, for example, if you want to examine populism in a two-party system like the United States. So this gives us a background of why the German case is interesting to address our question. We combine different sources of data to address it empirically. So we combine survey data on each individual in Germany covered by the German socioeconomic panel. We combine firm level data to measure the degree of exposure to the Commerzbank shock. And then we use these sources from the political science literature that allow us to categorize each party as populist or not. And we select in particular, based on this literature, 3 parties: Alternative für Deutschland, which is a far-right party, Die Linke, which is a far-left party, and then the National Democratic Party, which is another far-right party, which has never made it to the parliament, but I received still a significant number of votes, and is mentioned also by the survey, in the survey data that we're using. So in terms of the methodology, this is how we measure the exposure to the credit shock, and I'm just going to describe it briefly for the sake of brevity. What we do is to look at the relationship banks for each firm in Germany, covered by the Orbis database. And we are going to look for each firm at the share of Commerzbank accounts that each firm has, in order to have a measure of the degree of exposure of each firm to the Commerzbank credit shock, to this decrease in lending. Then what we do is to aggregate everything at county level, in order to have a county level measure of exposure to the credit shock, which we can link then to the replies of individuals, because we know the information about where each individual is located in terms of German county. So then what we do is to plug in this measure of exposure at county level and plug it into an intensity to treatment difference in difference model. Intensity to treatment because every county is exposed, but with different degrees, with different intensity. So this measure is at county level, which is interacted with the post dummy, so after the credit shock. And we are going to look at the dependent variable, which is at individual level for each individual I located in each county K. And we're going to look for a number of individual level and county level controls. So what is the dependent variable then? What are we looking at? We look in particular at this question in our baseline methodology, which is many people in Germany lean towards one party in the long term, even if they occasionally vote for another party. Do you lean toward a particular party? And we have the replies throughout time of these individuals. So what are we doing here? We are looking at the two different answers that we can extract from this question. The first is whether it's yes or no. So whether it's yes, if it's yes, it means that political support toward any particular party has increased or decreased. Whereas once they reply yes, they also select a specific party that they're supporting. So we can see whether this party is one that we categorize as populist parties based on the literature, or whether it's a non-populist party. So in terms of result, what we find is that political support, which is based on the simple yes reply, has increased. So following the exposure, being exposed to the shock increased my probability of voting for, of expressing my intention to vote any party. So my political support to any party, which is interesting because much of the literature says that with the crisis, there was a decrease in the attachment of voters to politics in general and lower turnout. But this seems to say the opposite. So there was an increase in the intention to support any party. And then we noticed that there is also an increase in the intention to vote for a populist party. So indeed, exposure to the shock is increasing my probability of voting for a party that is considered by the literature as populist. But as I was saying, we are not happy with this simple categorization of populism as being 1 or 0. So what we are trying to do is to use a seeded LDA approach, which is a semi-supervised learning method, applied to the text analysis database, which is initially the German Bundestag speeches, so representative of each party that go to the parliament and speak. And we can use this seeded LDA to compute, and I can maybe talk more in detail in the discussion since I have 1 minute left. They can talk more intensely with using a populist rhetoric compared to the other parties. So we have a continuous measure and not a simple binary categorization, vis-a-vis the focus on banking and finance. So how much each party focus on the topic of banking and finance when it talks in the parliament. For robustness, we also look at the electoral manifesto and the results won't change. So in terms of results, we see that citizens that are exposed to the credit shock tend to vote more for parties that discuss more intensely about banking and finance. So indeed, there is, if you talk about banking and finance more intensely, you tend to get these voters that were hit by the shock more intensely. But the coefficient of populism, so of using populist rhetoric, is actually double than the one of banking and finance. So there is also a reward of using a populist rhetoric, regardless of your focus on the topic of banking and finance. So to conclude, in the last seconds or minutes that I have left, we find that credit shock increased the support for populist parties. And in particular, we saw that being exposed to the credit shock increases the probability of voters of wanting to vote, so its intention to vote, this is important, for a party that uses populist rhetoric, but also focus more on banking and finance issues. So indeed, like, populist rhetoric pays off, but voters are not totally blinded by the populist rhetoric. So they are sensitive to the topics that populists discuss. However, what we are actually exploring more in the next step of this paper is what could be the mechanism behind this link. And one possible mechanism is that this is the result of a sociotropic reaction, as found in other works on the rise of populism. So it's not necessarily a direct impact of the credit shock on individuals, because we know from the data that the loans held by households have not varied that much following the credit shock. It was something that influenced more firms, but voters reacted to the general economic situation of the region. So this is like the sociotropic interpretation of this result. And with this, I conclude. Thank you for your attention.
Thank you, Nicola. Thank you very much. I have a question for you. Are you considering also sentiment index when you build topics on banking, you know, from the speeches of the different parties? Because I mean, it could be neutral, you know, a neutral speech, a positively oriented speech, or a negatively oriented speech. So I understand instead that you are somehow averaging out all the speeches by, you know, by parties. So are you considering this extension, and eventually which differential results would you get by distinguishing from positive, negative, and neutral sentiment?
Thank you. Should I reply directly, or should I?
Yeah, please. I mean, if there are other questions, I don't know from.
Well, I can reply immediately. So we deliberately decide to just look at populist rhetoric, which indeed is something that comes specifically from these works that try to build some seeds. So I didn't have much of the time to explain what the seeded LDA was about, but what we do is to do something that is similar to a topic analysis. So we add keywords, which is something that they do also sometimes in sentiment analysis. So they start with a set of keywords that are considered as positive, a set of keywords that are considered as negative or neutral. And what we do is to add in a set of words that are considered as associated with populist rhetoric. So for example, I remember from the top of my head that there is elite or establishment as being terms. Of course, we use the German terms. And so we don't use any lexicon that is a lexicon published as being positive or negative. So this is something that we don't measure with the standard sentiment analysis lexicons, so not those text bags, but we use this lexicon that is simply related to populist rhetoric. For the banking and finance, we do it first separately, so we just have a measure of how intensely they talk about banking and finance, indeed regardless of the sentiment, as you rightly pointed out. But then we do a second one that combines the two, so banking and finance and populist rhetoric. And we find that populist rhetoric is the most important one, so the one that has the highest coefficient. We didn't do it with sentiment specifically because we were interested in the aspect of populist rhetoric, but it's something that can be definitely be done.
Mm-hmm. Thank you very much.
Thank you.
Thanks. Well done.
Okay. Now the paper by Sara Mancini, Leonardo Becchetti, and Erminia Florio on internet exposure and social capital. Please.
Hi everyone, can you see the slides? Yes. Can you hear me?
Yes, of course.
Okay. So good afternoon everyone, I am Sara Mancini and I will present our paper Internet Exposure and Social Capital by Professor Leonardo Becchetti, Erminia Florio and me. So a lot is known about the influence that social capital and in particular trust have on economic outcomes, both at the micro level and at the aggregate level. This literature brings examples of how they link with economic variables such as income, growth, or for example, investment decisions and human capital formation. So our question was to try to understand then which are the determinants of trust and thus of social capital, which are the factors able to influence them. In this pandemic, COVID-19 pandemic, the focus was on the non-face-to-face relationships. And in particular, we study the use of internet of each individual daily, on a daily basis. So how the, let's say, internet exposure, we call it in this way, is able to influence the level of interpersonal or mutual trust between individuals. We contribute to the behavioral economic literature and to check for external consistency, and then we provide policy implications to face the problems which could be linked to the erosion of social capital, in particular in this historical moment. So we use data from, from the European Social Survey, following the literature, and which are individual level data, high quality individual level data, collected through interviews, and are about almost every aspect of demographic or socio-political and economic preferences of individuals. They are collected at the NUTS 1, NUTS 2, and NUTS 3 level. And we use 2 rounds, because in these 2, there was the question about the interpersonal, there were both questions on interpersonal trust and the use of internet. So we use round 8 and round 9. In the map, you can see the average level of trust reported in the survey by individuals in Europe. So to estimate, to test the effect that web use, web exposure may have on trust, we estimate an ordered logic model in which trust is our dependent variable, which is a qualitative and discrete variable measured on a 0-10 scale. So the question was, how much do you trust people? Where 0 is you can never be too careful, and 10 is the answer, you can trust almost everyone. So in this case, beta will give us the effect of the web use, which is our main regressor, and is measured in, it's the average daily time spent on internet in minutes. W is the vector of individual controls, and we included dummies for age, gender, in general every individual characteristic, and we included also country of origin and wave fixed effects. Okay, so here you see our main results. And we also divided, so here you have a continuous variable, so in minutes, and then we divided in time slots the use of internet per day. So from 1 to 3 hours, then to 3 to 6, and then 6 to more hours. And you see that our results are consistent, and in particular that actually time on web decreases the interpersonal trust also when we add the controls. Then we check, we do some subsample checks, and we found out that trust actually grows with income and education. So we find the effect to be higher or stronger for males and for low educated people. Our possible concerns about the endogeneity were mainly 2: spurious correlation and reverse causality, in the sense that probably having a lack of trust may induce itself to spend more time on web. Then we decided to perform an instrumental variable approach, and we use the strength of the web connection at the NUTS 2 level. In the map, you can see in fact, you can see the average strength of 3G connection in Europe. Yes, it's measured in dBm, and let's say they go from -30 to -100 and yes, 10, let's say. On average, more than 90, it's considered a good connection. So we estimate this first stage to least square model, in which you see that we use strength as an instrument. Here reported our table 3, which in which you can see in the first stage that our instrument is relevant. Actually, the strength of the connection influences the use of web use, in particular increasing 1 decibel. The strength of the connection increases almost 1 minute per day the use of internet. So our instrument is relevant, and then in the second stage you can see that actually our instrument is significant, and our results are consistent with the baseline model. So in the end, what we found, what did we find? So we analyzed the relationship between the web exposure, the non-face-to-face relationships, and the trust which was reported in the survey. And our results are consistent also when we include all the controls and fixed effects. We perform an instrumental variable specification estimate, and we find to check if the relationship, the association was causal, and yes, the instrument confirmed this association. And in the end, yes, we find that gender and education are factors that are relevant for in this relation. So the conclusion is that the pandemic was a huge, massive, and unprecedented experiment of non-face-to-face relationships. Obviously, we enjoyed staying home and maybe planning our weekend or planning our week, but we should be careful and we should be concerned about the possible negative effect that this could have on social ties, and thus on trust, and finally on social capital, and on economic outcomes. So our suggestion is to propose to investment to promote activities in which social ties and relational goods could be reinforced. Thank you.
Any question?
Yes, I would like to make a question if I can. So would you be able from your data to disentangle the reasons for spending so much time on the web? I mean, could you disentangle the hours spent on social networks or other activities? And also, if you could disentangle the instrument by which you connect to the web, in the meaning that, for instance, if you connect from a smartphone, could be different from connecting from a remote web PC. Is it this possible from your data or not?
No, actually no, because it's a survey and they didn't ask the source of the internet connection, so if it was a mobile phone or a computer. But maybe we can isolate and disentangle the hours worked per day, and maybe the type of job of the person, and see if, for example, hours spent are linked with the type of occupation of the individual. This can be done, of course.
Okay, thank you.
Thank you.
Okay. No other question?
Yeah, I have a question. May I?
Yes, of course.
Thanks. Thanks, Sarah. Thanks for presenting. Great work. So, very related to the previous question, have you looked at how age may change this trust web use link? Because I was thinking that young people may use internet differently from other age groups.
Yes, it's a nice suggestion. Thank you, Francesco.
You're welcome.
Yeah, the comments are more than welcome, and or also afterwards. But thank you all.
Okay. Next, Beniamino Sicoli.
Sicoli, yes, that's me.
Okay. Banking diversity, financial complexity, and resilience to financial shocks. Evidence from Italian provinces.
Yes, thank you. And I'm
Okay.
I'm Beniamino Pisicoli, a PhD student at the University of Rome Tor Vergata. So just a little motivation for this paper. As we know, the COVID pandemic is imposing unprecedented challenges to the global economy, and it comes after two other major shocks that have hit the global economy and in particular Europe. And even if the current turmoil did not originate in the financial sector, the latter has been, as we know, massively influenced by it, and it still is crucial in guaranteeing the survival of firms after during the hibernation of the economy and during the recovery. So this has given new momentum to the literature on the relationship between financial markets characteristics and stability. And we are entering this line of research by trying to answer to these two questions. So is diversity in financial markets beneficial to stability? And are more diverse local systems more resilient during financial shocks, or more resilient to financial shocks? But why should diversity matter? Well, previous literature has highlighted a number of channels that make diversity relevant. And for instance, more diverse financial systems are able to achieve a more diverse diversification. We know that financial intermediaries implement diversification as a strategy to minimize their risks. But if they are too similar, they will end up implementing a similar strategy of diversification, and the system overall will be more risky. But diversity also breeds inclusion, in the sense that when a single business model prevails, then consumers that are maybe excluded from accessing financial services. And instead, in a more diverse system, this issue can be alleviated. There could be also some beneficial effects of competition in this nexus, in the sense that the traditional charter value paradigm by Keeley associates competition in the banking system to greater instability, but recent theoretical literature and also empirical one is going against this nexus and is actually telling us that competition may be beneficial to stability. So in this paper, we're going to measure diversity in the Italian banking system at provincial level, following Mickey and Houghton. And then we're going also to propose an index of diversity and development of the overall financial system by implementing the algorithm, the complexity algorithm by Dalgo and Hausman. And we're going to test whether more diverse banking or financial systems are more stable in general, and whether these diversity increases resilience. So what happens to these diverse systems during bad times? I want to stress also very briefly what this paper is not about, because the word complexity may be, that can create some misunderstandings here, because we are not dealing with these issues that past literature has highlighted when using the word complexity and finance. We are not dealing with the excessive sophistication attained by financial markets or instruments proliferation. Here, the word complexity is a synonym for diversity and development of the overall financial system. And we use the word complexity only because we are applying the complexity algorithm by Hidalgo and Hausman. So how do we measure diversity in banking? We follow Mickey and Houghton that consider 4 dimensions. That is ownership diversity, and we measure it on bank branches by ownership structure, we consider joint stock, popolari, cooperatives, and foreign banks. Concentration and competition measured as 1 minus NFI enlargement index calculated on bank branches by banking group. We also consider geographic dispersion and within province geographic dispersion of banking services by using the average distance between each branch and the province main city, normalized by the size, the dimension of the province. And we are also going to consider funding strategy diversity, that is actually the sum of two components that consider concentration of the loan deposit ratio and funding gap spread. These are some aggregate indexes that we are going to consider, and the most comprehensive one is the diversity original that comprises all of these dimensions. As for the diversity measure, we will implement the algorithm by Hidalgo and Hausmann, and the traditional setting of this algorithm is export data. Here instead we're going to apply it on data on active firms in the K section, financial and insurance activities of the Ateco classification. So the first step to implement this algorithm is to build a binary matrix that based on RCA measures, Balassa RCA rebuild comparative advantage measure. And from this binary matrix, you can get two dimensions, two key measures, that is diversity by summing over the rows and ubiquity by summing over the columns of this binary matrix. And the algorithm by Hidalgo and Hausmann uses the method of reflections. That means basically correcting province diversity for the average ubiquity of its financial intermediaries, and then for the average diversity of similar provinces, and so forth. So we're going to apply this algorithm to the K section of the Ateco classification and calculate an index of complexity for 100 provinces. We're going to consider Sardinia as a single unit and also some aggregation of newly created provinces to the entity they were previously part of. And as for our dependent variable, we will use the non-performing loan rate on borrowers that has been used as a proxy for financial instability by several papers. And we are going also to use a very huge number of data sets coming from Bureau van Dijk, ISTAT, and the Albo di Vigilanza from the Bank of Italy. So let's have a look to this non-performing loan rate and its evolution. And there are two facts here that I want to stress. The first is that, as expected, the peaks of NPL comes during the Great Financial Crisis and the sovereign debt crisis. And the interesting fact here is that COVID is that 2020 data. Indeed, as we can see, during the 2020, the non-performing loan rate did not increase, contrary to what we expected. And, this is a result that is very strange at first sight, but if we think about that, we can realize that the measures undertaken by the government were quite effective. And in particular, I'm referring to loan moratoria that were implemented both by the government and also by private initiatives of the banking sector. But we have to take into account this could also bias our results. So we're going to try to answer to these three questions. Is banking and financial diversity beneficial to stability? And we implement this linear model in which the non-performing loan rate is a function of diversity. Then we're going to use an interactive model in order to capture the effect, the influence of the greater diversity during bad times. And finally, we are going also to speculate about potential transmission channels by regressing different measures of loan concentration on diversity. So let's see our results. And in this first result, this is the linear model. As we can see, all the measures of diversity of the banking and financial system are negative and significant. So this means that actually more diversity in the financial system helps stabilize the local economy. And this is instead the interactive model. And as we can see, as for the results on banking diversity, the interaction terms are always negative and significant, even if the linear coefficient is positive, but the algebraic sum of all the coefficients is still negative for all these three first columns. While the situation for the diversity of the overall financial system is rather different. And in this case, it's only during the sovereign debt crisis that a greater diversity helped stabilize the system. And some additional results here. So as we have seen in the previous brief literature introduction, there are different channels that might be relevant here. And even if our data does not enable us to disentangle which is more relevant, their ultimate effect is the same, and that is that a greater diversity improves diversification of risks. So in this first case, we are going to regress measure loan concentration as measured by the percentage of loans detained by the top 0.5% of borrowers on diversity. And we can see that diversity in the banking system matters, while this is not true for the overall financial system. But the situation is different when we consider loan diversity as measured by a diversity index on loans by economic destination. In this case, it's the role of the overall financial system to matter. And this is the same when we consider loan diversity by borrower category. So the interpretation of this result is that, in my opinion, when we are able to find beneficial effects of the financial system or diversity of the overall financial system on stability, on diversification, is when we can actually remark the role of alternatives to banks, so alternative intermediaries to banks like factoring firms, finance firms, institutional investors. And these can, of course, be highlighted when we can consider less traditional type of loans. And this is what happens when we consider loans diversity by economic destination and by borrower category. So we got also a vast array of robustness checks. We're going to use different dependent variables that do not consider the non-performing loan of households. We are going also to change the date of NPL for 2020 to alleviate the presence of loan moratoria by using data coming from the end of March and the end of June. And we are going also to introduce some instrumental variables in order to limit endogeneity and demand effects when we consider our additional results on loan concentration. So let me conclude here. And in this paper, we have seen that both a greater diversity in the banking and financial sector is beneficial to stability, and that diversity in the banking sector has helped to alleviate, to curb the impact of the three shocks on the local economies, while the overall financial sector diversity has been beneficial during the sovereign debt crisis. And even if we are not able to disentangle clearly which mechanism can be more relevant, we see that the ultimate effect is confirmed. So greater diversity promotes better diversification, and this makes the system more stable. And as we know, today's for the recovery from the COVID pandemic, we need a well-functioning financial sector. So we have seen that probably financial diversity is one of the arrows in our quiver for the recovery. And thank you for your attention.
Okay, any questions? Thank you very much.
Thank you.
Now, a paper by Francesco Sallustri, Leonardo Becchetti, Fabio Pisani, and Lorenzo Semplici on the frontier of social impact finance in the public sector, theory and two case studies. Okay, go on.
Hi, everyone. Thanks for having me here. So before starting my presentation, I'd like to ask you to make this presentation less virtual. How many of you have ever heard about social impact bonds? Could you please raise your hand if you have already heard about social impact bonds? Either virtually or... Okay, thanks, Pasquale, and thanks the other for not raising your hand if you have not heard about social impact bonds. So this paper is actually about this. social impact bonds, which unfortunately are not bonds. So social impact bonds are new financial mechanism for delivering public services, usually in the welfare sector. So these are financial mechanisms that local administrations use to deliver social services or welfare services. The simplest version of this model sees a commissioner and a provider. The commissioner, which is the government or the local administration that aims to deliver the service and commit the and the provider, which is because of the welfare sector, is usually a third sector agent that practically delivers the service. So we can make this model more complex as we like, thinking at external investors funding the projects and intermediary agents like banks managing the funds, or external evaluators. But we will try to keep this model as simple as possible in order to make a theoretical framework for social impact bonds. Examples of SIBs, which is the social, which stands for social impact bonds, are in the sector of prisoner recidivism. So they are projects aimed to reduce recidivism for people in prisons. They are also targeted for rough sleepers, or they aim to reduce school abandonment. It has been they have been implemented worldwide, mostly in the UK and the US, but also in Australia and Italy. And they are very recent. In 2015, about 100 projects have started or planned, and now there are slightly more. So what this paper does, so we started this research because there was this very recent concept, social impact bonds, implemented or started, conceptualized approximately around 2010, so 10 years ago. And a proper economic theory is still missing, despite there are some projects exploring these, or some local administrations exploring this way of financing projects. So what we do, we sketch a perfect information model where we have a private investor and a local administration. Both have participation constraints, and the local administration may be risk averse or risk seeking. We do the exercise of calibrating this model with 2 case studies in Italy, one on jail recidivism and one on health, and I'll present today only the jail recidivism one. And we also discuss how the model can be extended in an asymmetric information setting. We find that all costs being equal, a social impact bond requires a risk-seeking government to be activated. And when costs are different, by costs I mean costs faced by local administrations and costs faced by the third sector agency, the social impact bond in that case allows for any government risk aptitude. So we can also implement a social impact bond with a risk-averse government. So this paper is novel because it implements a theoretical model informing policymakers on the optimal conditions for social impact bonds, and it provides a kind of tool to compare different projects and see which is the optimal one. Literature review has been up to now very qualitative, and this but it's growing actually, and the OECD in particular called for more research on social impact bonds and how to design a perfect policy for welfare projects. So it has been quite qualitative, and that's why we started this quantitative or theoretical mathematical model. Just a few information on the model. We have a government, a local administration that wants to implement the social activity, assuming it has a cost X, leading to a successful outcome Y with probability P. Or alternatively, it can lead to a failure outcome F with probability 1 minus P. So the local authority has to choose to either to implement directly the activity or using a social impact bond. If it prefers using a social impact bond, the social impact bonds can be defined as a share of the profit in case of success, or a guarantee fund in case of failure. So the local authority, the local administration promises part of the profits to the provider, to the service provider in case of success, or a guarantee fund in case of failure. So the optimal social impact bond consists of a couple of share of profits and guarantee fund. The participation constraints for the government basically says that what the government would gain without a social impact bond must be lower than what gained with a social impact bond. And of course, since it's the government is sharing a part of the profits and is paying a guarantee fund, there must be a factor K that basically captures the risk averts or the risk attitudes of the government. So if the government is risk neutral, that K is equal to 0. Otherwise, if negative is risk seeking, or if positive is risk averts. The more risk averts, the more likely for the government to implement the project using a social impact bond. And on the other side, we have the private investor, or if you want, the third sector agency that needs to be to run the project and have as a return at least the same amount that you would have with a standard investment using standard bonds, for instance. So the maximization problem writes this formula with these constraints I showed you, and we have a first impossibility result that says that if the government is risk neutral, the social impact bond is not feasible. That means, according to this simple model, the local administration would not find optimal, convenient using a social impact bond, and the optimal and that's why the K factor is crucial in our model. The optimal solution writes as follows, and we can discuss these formulas with two remarks. So the success outcome must be sufficiently high, otherwise the third sector agent is not sufficiently incentivized to enter into the project. And the failure outcome must be sufficiently low for the same reasonment. We calibrate this model using the case of jail recidivism implemented in the south of Italy from 2007 to 2017. This project called Made in Carcere tried to train female inmates in the craftsmanship sector to reintegrate that women at the end of their period in prison and reduce recidivism. So we input the costs as shown in this slide, that are costs taken from this project, and we ended up with with a calibration. I'll not go into the details, but basically our calibration says that according to this data, the social impact bond was in that case feasible, even though the model is simple and some data are of course arbitrary. We also played with some key variables, like the outcome failure in case of failure can be null, or it can be part of the full outcome in case of success, like this variable here. So either is 0 or is 1/3 of the full successful outcome. And we see how these change the optimal variable, or the optimal social impact bond variable, which is the profit of the gains and the guarantee fund. Of course, the local authority in this case likes to have the guarantee fund lower, in between 0 and 1. And we also played increasing the fixed costs and see how fixed cost reacts on the affects the risk attitude of the local government. So the higher the fixed cost, the higher the risk aversion of the government must be. We did a similar exercise for the case of health budget, aiming at reducing hospitalization for for patients with mental disorders. And we discussed all relevant variables for this health project. Last slide is about discussion. We are trying actually during this week, we are trying to implement the model in an asymmetric information setting where the investor or the private can put high or low effort, and the government can monitor with a cost. However, the very important nature of this social impact bond that differs from private-public partnership is that there are intrinsic motivations of agents, because of the third sector agents must be more committed to deliver the service regardless the payment, that has positive impacts on the asymmetric information side, but also may have negative impacts on the project selection of the project, because we may have the cherry picking effect, selecting the projects that are most likely to be successful. And then we try to answer why some sectors have been funded using social impact bonds, while others no, while this is not the case for other sectors, and see if there are some sectors where the government may have higher administrative costs or less expertise that make social impact bonds more suitable. Thank you very much.
Okay. Some questions? Well, now comes the Daniela Fantozzi and Alessio Muscarnera paper on a new base policy index for Italy, expectations and fiscal policy.
Good evening. Good evening, everybody. This is a work joined with Alessio Muscarnera. I'm Daniela Fantozzi and working at ISTAT, that is the Italian National Institute of Statistics. Okay, so. Okay, this work evaluates the effect of a news-based policy shock on consumption and investment in Italy, supporting the hypothesis that fiscal policy is largely anticipated and its effect depend on expectations about future policy actions. So instead of relying on a theory-based identification, we analyze a novel news-based anticipation channel, and in doing so, our contribution is First, we adopt a web crawling programming procedure to build a high-frequency textual database using the most important Italian newspaper, and we exploit a novel empirical approach based on text mining and constructing a fiscal policy news index for Italy. So after that, we use in a structural vectoral autoregression our policy news index to assess the dynamic link between the news coverage, agents' expectations, and the macroeconomy. So how do we compute a news-based fiscal policy index? First, by collecting all newspaper articles of the most important Italian newspaper, and then by narrowing the sample by filtering out articles without fiscal terms, and finally applying a reduction procedure to corpus articles that have a combination of fiscal words, for example, using journalistic jargon like ecobonus, tax revenues, Jobs Act, Equitalia, and so on, with specific future and conditional verbal forms. So not only future tense, but also some verbal future expressions like it is expected or it is coming and so on. So we end up with a fiscal news sample of more than 37,000 daily articles. And finally, to isolate as much as possible fiscal policy announcement, we adopt a dictionary method following Logran and McDonald dictionary, in which we translate the uncertainty word list into Italian language and augmented it, of course, with some Italian specific words related to uncertainty and expression. And we drop out, after that, we drop out articles that contain more than one uncertainty word. And so our final fiscal news sample without uncertainty news per day is about 12,000 news articles. And so we are able to construct our fiscal policy news index as the ratio between the number of fiscal terms per article per day divided by the total words per article per day. And similarly, we have computed, useful for macro analysis for some robustness check, we have computed a fiscal news index directly from the news sample, the larger one, which contain also uncertainty words. And in the same way, so indexes capture the intensity of fiscal topic per news weighted by words per article. Only this graph represents the dynamic of the volume of the articles starting from 1997 up to 2019, and we observed that after 2011, so after the sovereign debt crisis, the volumes of articles increased a lot. Our main questions are, we wondered if media coverage of fiscal policy affect real changes in the macroeconomy, and if fiscal news topics are good predictors of fiscal policy actions, and to what extent fiscal news coverage exhibit a causality link with consumers' expectations, consumption, and other macro variables. So, because of the existence of legislative implementation lags, as we know, fiscal policy actions are to some extent anticipated. And for example, Forni and Gambetti and others found that agents receive signals about future changes in taxes or in government spending before these changes actually take place. And in particular, Rami in 2011 provides evidence that the relevance of the foresight, showing that government spending shocks estimated without BR are predicted by the forecast of government spending by the survey of professional forecaster. So to analyze how media coverage measures affect the macroeconomy, and at the same time to address the issue of non-fundamentalness of fiscal shocks, we use our policy news index as a proxy variable of a fiscal announcement, say a government spending announcement, in order to capture the effect of fiscal foresight and to properly evaluate the agent behavior in shifting their decision of consumption and investment. In detail, we adopt two measures of fiscal announcement. The first one is our policy news index, as already seasonally adjusted and collapsed quarterly. And the fiscal news index, remember that contain uncertainty word for some robustness check. So our basically our we use a Bayesian VAR with a diffuse prior, in which we our endogenous variable are the government spending that we ordered first as in Blanchard and Perotti, because the implied assumption is that the government spending shock is a surprise shock, is an unanticipated shock. While our policy news index is ordered second because the assumption is that it does not affect government spending contemporaneously, but it responds with some delays. The other variable are the consumer confidence on future economic conditions, the household consumption, so the private consumption and investment, and net primary surplus, and finally spread. So our main results, we observe first in the first panel on the left side the effect of a positive government spending shock on the other macro variables. And on impact, we observe that on impact, the confidence, that is climate, the consumer confidence upsurge on impact and then slightly decline, while investment and household consumption have an up-shaped pattern. In the panel on the left, we can analyze the impulse response function after a positive news shock, that is a positive announcement shock on government spending. And as we expected, the response of government expenditure upsurge after with some delay after 3 quarters, as expected, and consistent with the recent empirical literature about fiscal foresight, but differently and surprisingly differently from the recent literature, investment and private consumption are almost zero, and responses with some delay too. So the main channel, a relevant channel, according to us, a relevant channel after an announcement shock in government spending is the confidence channel, because the confidence channel seems to anticipate somehow the reaction of the consumer. So because the volume, the more intensity in the news coverage, the more quickly agents revise their expectation. So the relevance of the confidence channel is showed also in this counterfactual exercise, in which we zero out the impulse responses coefficient of consumer confidence using the same relationships estimated in the BR1 to generate a counterfactual scenario in which agents' expectations are insensitive to policy news shock. So in our counterfactual scenario, that is the green dashed lines, the responses of consumption and investment differ substantially, meaning that agent expectations are a critical factor. So consumer confidence, agent expectations are a critical factor in the transmission of policy news shocks into economy. So our conclusion are that, unlike the recent literature, we show that news or foresight shock has a delay effect not only on government spending, but also on consumption and investment, and that the confidence channel plays a crucial role. Consumer confidence anticipates the effect of news better than consumption and investment, and agent seems to be expectation driven. So the story is that agents receive mixed signals from newspapers about changes in government spending, and they may rationally make decisions based on incomplete information set, incomplete information framework. So because of lack of credibility and rational inattention, they do not react before changes are fully in place. And thank you.
Any questions?
Yeah, I have a question.
Yeah.
Hello?
But maybe Professor Corrado was before me.
Nicola, you go first.
Thank you, Daniela. Just a clarification. So I didn't really get whether how you construct the uncertainty index. So because I understood that you use the uncertainty terms, which seems to me the similar technique to the economic policy uncertainty index, which usually like combine indeed the word uncertainty with words related to fiscal policy or this kind of stuff. But then you mentioned also the Loran and McDonald, which reminds me more of this sentiment dictionary that indeed Professor Corrado mentioned before. So like, do you do like a polarization index based on the difference between positive and negative sentiments, or it's just?
Okay,
yep.
Not for the moment. Thank you for your point, your good point. Not for the moment, but we are, me, Alessia and me, are working on the polarization and on a construction of a kind of sentiment index about fiscal announcement, if positive or negative, because we are aware that a polarization is a good indicator to analyze in depth this kind of responses. So we are working on this.
So far it was just the word uncertainty with fiscal.
Yes,
okay.
Yes. So our indexes measure only the intensity, the volumes of articles that contain both the combination of fiscal terms and future expression or future tense.
Thanks.
For the moment.
Thank you, Daniela, for your presentation. I think this point was raised also during your Viva, so I'm just asking you again this point for clarity. Can you check whether there is any asymmetric effect in terms of business cycles? So whether these effects are the same if you are in a recession or in a boom? So in other terms, whether these news effects are the same and there are eventually asymmetries that you may account for in your analysis.
Thank you, Luisa. Yours is a good and interesting point. And for the moment, because of the lack of a sentiment indicator, at the moment we are not able to measure it, to analyze some asymmetric effect, if any, of course, and to disentangle the reaction during the recession phase and during the a positive phase of. But we are working on the sentiment indicator that allow us to address your question, your point.
So can you maybe create like an interaction dummy between the news and the business cycle? You know, in order to get this differential impact, can you do like a sort of?
Maybe this could be this could be a way, but another way is to use, for example, a polarization of the index about positive and negative announcement on fiscal government spending or an increase or decrease of taxes, for example. Use directly this index in the VR.
Yeah, I'm thinking more about actually a regime switching VR. You know, so you have a switching regime between you know ups and down in the business cycle, but that would be a different technique that probably can deal with the same asymmetry.
Yes, of course, this could be a possibility.
Okay, thank you so much. Thank you, Daniel.
Thank you all.
Okay. Any other question? No one. So we can conclude this session. Many compliments to all presentations. And we hope to see you next time to Villa Mondragone.
I'm sorry, Giovanni, there is another speaker.
Another paper,
yes,
sorry.
Juana Paola Bustamante.
Yeah.
Yes, who's waiting for us. So
I see now, yeah.
We should allow Juana to present her paper.
Okay, sorry. Now the paper by Juana Paola Bustamante.
Thank you.
On the effect of innovation on employment, a firm level analysis of manufacturing firms in Colombia. So, sorry, very sorry. I'm terribly sorry.
I promise I'll be short. Okay. Okay, I hope you are able to see my screen.
Yes, we are.
Okay, good. That's yeah, that's very good. Great. Okay, so yeah. Okay, so I'm just trying to hide this. Okay.
Excuse me, I've been several times in Colombia, but I never had the impression that the innovation activity is going on. Is any evidence about this in your paper?
Yeah, sure.
Sure. Okay.
Just let me go for it. So okay, so this one is the effect of innovation employment, a firm level analysis of manufacturing firms in Colombia. So the motivation of this paper is towards the future of jobs. This paper was done before, well, actually in the midst of the pandemic, but I didn't take into account the impact of COVID-19. However, it brings a lot in terms of policy for the future. So the future of jobs, firms introducing product and process innovations will impact their demand for labor. We all know that. And the consequence in the futures of job is great concerning the countries, and even now with what's going to happen after COVID-19. The introduction or adoption of innovations at the firm level may differ across developed and developing countries. So the main question here is how to assess the effect of innovation on jobs at the firm level. This is at the firm level, this is a micro analysis. Very quickly, in terms of literature, the potential effects of innovation and firm level employment, it depends on the relative intensity of the displacement and compensation effects. So you can see here the table, depending on the type of innovation. So this is the kind of, this is based on community service of innovation, more or less like the same style of the European ones. So product innovation, we have product innovation and we have process innovation. And these tables summarize some displacement of effects of workers and compensation effects. And actually the literature is related to that one. So we have on the literature that innovation tends to be positive related to employment in many papers. But product, when we differentiate between product and process innovation, this starts to change. So some papers and authors find that product innovation is actually associated with employment growth, but process innovation may have different effects. Some of them may have displacement effects, some of them they don't find any effect at all. But overall innovation, which is good, stimulates employment. In terms of Latin American, just focusing on Latin American studies, there are
some mixed findings, and these mixed findings are due to lack of data availability, lack of comparability, how the surveys were processed. So I go further in this paper to give some light on this. So what do I use? I use in the theoretical framework, I use the paper based on Harrison, Jamandre, Merez, and Peters, and also the paper by Hall, which is applied to Italy specifically. Very briefly, the main assumptions of the theoretical framework is based on firms. So there are a firm that produce two types of goods. Some goods are all goods, goods and services, all goods and new goods. Firms are observed in two points of time, and each type of product is produced with constant returns to scale in capital, labor, and intermediate goods, and identically separable technological production functions with different Higgs-neutral technological productivity. Firms invest in research and development to generate innovations, and the predictable, efficient impact is reflected in theta. So I'm not showing, due to time, the main equations. So the authors use a production function, a demand for labor, they combine it, and then they derive an employment growth equation. This is employment growth using the labor demand equation and assuming that the prices of inputs are constant in time and equal for both old and new goods. Then we get this equation, which is the employment growth equation, which we have the change in efficiency for all products, y, log of y in period 1 and log of y in period 2, which would be the rate of change of demand for all products, and then the expansion due to the demand of new products. How we translate this into an empirical estimation strategy. I'm not presenting here the original empirical estimation strategy, but I'm presenting the one that the extended, the one that is very close. I'm gonna tell you what I changed. So first, the dependent variable is the employment growth, which would be L, which is the rate of employment growth between the year T equal 1 and T equal 2, minus the rate of sales growth of production for all products. And on the right-hand side, we have F, which is a new variable that I estimate, which is the relative efficiency in production of the firms. We have to remember that when estimating these kind of models, if we don't estimate, none of these models have estimated until now the relative efficient production in the firms, because in order to do this, you need a really good database that combines many kinds of surveys. So this is a very, very strong thing that I managed to get. So I estimated this variable, which is the relative efficiency of the firms. Then we have D2. D2 is a dummy variable, which takes the value of 1 if an innovation is implemented in a process and product innovation at the same time. And then when you see the fourth element at the right hand side, which is beta 0 plus beta 1 multiplied by D2, all multiplied by G2 is what I'm trying to measure there is the combined effect. D2 is a dummy variable, which combines when process and product innovation are done at the same time. And here is an assumption. The survey doesn't allow me to know if when a firm is introducing process and product innovation, if this process innovation is related to all products or to new products. So this is an assumption that I do, which is also based on Hall's paper, because Hall also does this assumption, and is that the combination of product and process innovation is related to new products. And then, well, we have the trend. What is the data? The data that we are using is a panel database between 2008 and 2016, which is made of two kinds of surveys. First survey is the annual manufacturing survey from Colombia, which is conducted by the National Statistical Agency, DANE. This annual manufacturing survey contains information on sales, production, use of labor, capital materials, and other firm characteristics. This was really, really important for me in order to estimate actually the efficiency variable. Then I also used the panel, I built the panel database from the Survey on Development and Technological Innovation in the Manufacturing Sector in Colombia. This is a survey that is done every 2 years. And then I merged these two surveys so I could have the whole panel. So it's a 5-way and balanced panel database from 2008 to 2016. The database consists of 42,000, an average of 42,000 observations on manufacturing firms in total. Both surveys are stratified according to economic sectors and geographical location. Okay, here is some really quick descriptive stats. So you can see here the number of firms, then around 27% of firms are innovators. They can be differentiated by process innovator, product innovator, and both process and product innovators. And around 73% are not innovators. The main paper has got all the descriptive stats on employment growth, on sales of new products, and all of this, which I don't have the time here to present. So in order to estimate our equation, we need to account for endogeneity, for the endogeneity of the sales due to new products. So first of all, we are using sales of new products and not the production, the actual production, because when I went through, well, none of the papers use the production because they don't have both surveys to merge. I had both surveys. I could have the production, but I couldn't use it because I would have to assume that this production would be the same that is sale, actually, which is not the case. So well, I instrumented the variable for sales. I used the increase in the number of goods or service offered, which would be product innovator that contributes an increase in the range of products. R&D and cooperative agreements in innovation. This is very interesting because actually the innovation survey provides cooperative agreements that the firm has established to generate some innovations. Some results. So this is, I'm presenting here just one of the results, which would be the extended model, which includes the efficiency. So first of all, yes, the model confirms that an increase of product, if a firm generates product innovation, that it increase employment growth. This is intuitively, and this is positive related, which would be our first variable. And when I did the comparison with the regression without instrumenting, then you can see the difference that it was biased downwards. Then the interesting efficiency variable is very significant and is negative. You can see here in this regression that the variable only for process innovation, I didn't include it, but I didn't include it because I did some estimates and it was not significant. But that doesn't mean that actually there are not displacement effects due to process innovation. Maybe that means that I'm not capturing, or that means even that in developing countries, what happens is that many firms actually do process innovation, but maybe just to meet standards of quality that are nationwide or certain laws, so not necessarily are displacement effects. However, the efficiency variable might be capturing these displacement effects associated with process innovation. So we have the efficiency variable. This is the relative efficiency variable. Then we had the process and product innovation related to new goods is not significant, so I cannot attribute that to them. So firms that innovate in both ways have also an effect on employment growth, which is D2, the variable D2, which is process and product. So what is confirmed here is that innovation in developing countries like Colombia often entails a combination of process and product innovation simultaneously. Which is intuitively correct in the sense that when we see the descriptive statistics of the firms in Colombia, we can see that a very low percentage of firms are actually innovating products that are new to the world. Very, very, very small one. This percentage of firms will behave very similarly to firms in high-income countries. Very competitive, very everything. But there are other firms, which are the most percentage of firms, that are very low in this process, that there are imitators. And in order to be imitators, they have to introduce both process and product innovation simultaneously. The sources of employment growth results confirm that the contribution of growth of sales of new and old products to employment are positive. Simultaneous process and product innovation is positive related to employment growth. There is no evidence of significant employment displacement effects from process innovation only, and displacement effects from differences in relative efficiency of the manufacturing firm, it's found there. Firm heterogeneity is important for explaining the effects of innovation on employment. So how do I see firm heterogeneity? Through the difference, the relative efficiency, the difference in relative efficiency across firms. So firms that have efficiency values close to 1 have higher labor productivity, which is similar to results from developed countries. What means that? That those firms that are very close to the frontier production, if they implement product innovation, then probably they will reduce employment growth. But this is not the case for the most of the companies, of the firms in Colombia. Actually, most of the firms in Colombia have this efficiency value under 0.5, which means that actually they can grow, they can innovate, and they will not make displace have effects in the negative effects in employment growth. They will actually demand more employment because they are very, very far away from the frontier. So there's positive news in that sense for Colombia, and most of the firms show efficiency values far below 1, and in this case, increases in efficiency do not have such a negative effect on employment creation. Thank you very much.
Okay. Okay. Any question?
Yeah, I have a question. If I'm still on time.
Okay.
Yeah, I can. Okay, last question.
Yeah.
No, I was just wondering, so whether you observe any heterogeneity in terms of firm size and age. So I know, I'm not an expert of the literature, but I know, for example, in the US, they found that the effect of innovative firms on job creation is generally larger for firms that are younger and small, like startup firms, so to say. So I was wondering whether there is something similar in Colombia and whether you observe something like that.
Yeah, thank you. Yeah, that's very, very interesting, because actually that paper, for instance, the one that you have seen and everything, is also combined with Slava, which is she writes a lot with the guide in the states that produce, and they produce a comparison actually between Colombia and the countries, and they see how the difference is that the part of imitation and creative destruction of firms is more intense in developing countries, right? Because you have informality, because you have all of these things. So you can see that innovation is across all the firms. However, I didn't explore. I wanted to explore that part, but I didn't explore it because age is if you see the whole range. First of all, I would need more than 8 years that I have, right? Some of the, because 8 years, you can say that there are still, I mean, 4 years startup, then I take a year, which is the 2009, which is a financial crisis. So then there many companies just broke, and you can see that, right? So that I couldn't control for. So really, I cannot give you that, but the difference in innovation, it comes across like different kinds of size. It's not clear on that one.
Okay. We can now close the session.
Before I close the session, Giovanni, may I say something about this? Because I am particularly interested in this session, as you know, and I thank you very much, you and the co-chairman, because Luisa Corrado, Pasquale Scaramuzzino, and Paolo Caronpari, because not only because this session dedicated to Giancarlo Marin, that been a colleague of ours, dedicating a lot of his effort to the young people, to the students. Also because we have the opportunity to increase the number of Tor Vergata students and in general, not only Tor Vergata, but the young economists trying to be on the area of on the career for economists. And it seems to me that we have to offer to this young economist the opportunity to be successful. And this is only a beginning. It's more, but as you know, Giovanni, thanks to you and Luisa and Pasquale, along the years you try to have a lot of young economists going on the academic, activity. And let me make a proposal to the young economist to become the fellow of the foundation, economic foundation of Tor Vergata. I am the president of the, as you know, the economic foundation of Tor Vergata, and the selection of the best paper for the young economist section make be sure that to get this the author and the economists that participate to the session member as fellow in the Faculty of Economics and the foundation, Economic Foundation of Tor Vergata as a fellow economist could be a way for, taking the opportunity or giving the opportunity to them to be inside the university institution. Okay, this is a proposal. The colleagues that are the chairman of the session could check the interest of the young economists and then to report to me their willingness to do that. Okay.
Good.
Okay.
Thank you very much. Thank you, Luigi. Yes, I'd like to very much endorse your proposal. I think it's a wonderful opportunity to have bright young scholars join the foundation and Tor Vergata. I'd like to thank you for organizing this session and also for having the idea of dedicating it to the memory of Giancarlo Marini. He was a dear colleague and friend And apart from being an outstanding scholar, he devoted a huge amount of efforts to the education, training, and mentoring of young scholars. So I think it's quite appropriate to dedicate this session to him. And just remind you, Giancarlo Maini started his academic career at the London School of Economics. He did his PhD with Janet Yellen and Willem Bouter, and then Professor Paganetto wanted him to return to Italy and called him in and joined Tor Vergata, the young faculty of Tor Vergata. So Professor Paganetto was very instrumental in having Giancarlo come to Tor Vergata. I'd like to thank very much also the speakers. As Professor Paganetto said, it's very encouraging to have such a wealth of talent. And I must say, I always find the Young Economist session one of the most interesting and stimulating in the whole conference of Villa Mondragone. And so I'd like to praise you for your work. Also say that I think on average, you are also much better at timekeeping than some of your older colleagues. So well done. And one good point also of this session is that we managed to achieve a gender balance, which is also quite encouraging. So thank you very much for that. So I'd like to thank the joint chairs, Giovanni Piersanti, Luisa Corrado, Paolo Canoferi. Thank very much Professor Paganetto for his encouragement and for his support. And thank all the speakers and the participants. So thank you. Thank you.
May I add, first of all, may I thank Professor Paganetto again for organizing this session, which is really, we are proud of our students, so it's an opportunity for us to display the research. And may I also deliver a good news, because also Professor Paganetto has been coordinating our PhD for many years. 3 of our students have been awarded the award by the Italian Society for Economists as for the best thesis in economics. So it was Luca Brugnolini last year, then Walter Ferrarese and Silvia Sopranzetti. So 3 students of our PhD program have been awarded this recognition from the Italian Society of Economists, and it's really, we are particularly proud to be to have been recognized in Italy as the best PhD program for 3 times in the last 5 years. So it's a great honor.
They could be candidate. They could be candidate to be fellow too. Okay.
Yeah, of course, absolutely.
Okay. And I hope to in the next future to have some financial resources to support their activity. So you have founded this new institution that is the Villa Mondragone Development Association that can operate in this perspective. Okay, my best to everybody. Thanks for this session, because the session in reality is the result of your report, of Luisa Corrado, Pasquale Scaramuzzino, Giovanni Piersanti, and Paolo Canofari. And I am just putting the conclusion, but the premise is yours. Okay, thank you.
Congratulations to everyone, really. Well done, well done.
Well done. Thank you very much.
Thank you.
Thank you.
Bye.
Thank you. Bye.
Tomorrow, I remember to everybody that tomorrow we have conclude the section, the session of conclusion and policy recommendation in the Ministry of Foreign Affairs. As every year, each year we have this session dedicated to make diffusion of our ideas. And this is the reason why it's in Italian, not in English, because the journalists and the media are more have a propension to take the ideas, but if to take the ideas is not so difficult and not so is easier than to take the idea by an English text. So if you are interested, take into account that tomorrow morning there is this opportunity. But if you want to take the opportunity, you have to talk with the staff just because Ministry of Foreign Affairs want to have the list of the participants. Okay? My best.
Okay.
Thank you. Then thank you. Bye. Then.
Thank you.
Thank you.
Thank you. Bye.
Bye. Thanks.
Bye.